Okay, hello everybody. Welcome all to the SOA faculty webcast for industrial engineering software and kind solutions as a local pension company BCD group. Before getting started, I'd like to go over a few housekeeping items. We now assume, so we will. You can ask questions in the Q&A box or just in case in the chat box. So we will have Q&A time after each presentations. So you may type your questions in the question of the screen, or you can send in your questions anytime during the presentation. Actually, I encourage you to send more questions to make the things more interactive. Your questions will be collected and we will hopefully adjust during the Q&A sections after each of the presentations. Now it is my pleasure to introduce you to the speaker of the welcome remarks, Andy Peterson, Managing Director International at the SOA. In that capacity, Andy oversees the SOA activities outside of the United States in advancing the actuarial professions through education and research. Andy works with the board to establish SOA international strategy and oversee the work of members and staff around the world in implementing that strategy. Prior to taking on the international role in mid-2018, Andy served as the Senior Staff Fellow for Retirement, where he worked with SOA members to develop and support better retirement systems. Andy received a BS degree in mathematics from Taylor University. He's a Fellow of Society of Actuaries, members of the American Academy of Actuaries, fellows of the Conference of Consulting Actuaries, and previously was an Actuaries. So now, without further ado, welcome Andy on stage. Over to you.
Thank you, Billy. Appreciate the welcome, and thank you for your role in moderating today's webcast. Let me also extend my welcome to all of you on behalf of the Society of Actuaries and our staff who've worked together to put this together. We appreciate all of you as professors and faculty members of various universities and your participation today. We know you serve a very important role in the context of educating students and educating students who want to become actuaries. And so we value your role and value your service as teachers and the serving the next generation of our youth. So let me just highlight that as an area of appreciation and thanks to you. As you may know, we have tried to put an additional focus in 2024 on connecting with all of you as university faculty and professors. This is our second webcast in a series we're doing for 2024. The focus of today's program is really on addressing the sort of the wider fields in which actuaries work beyond sort of the traditional areas. I mean, we'll still touch on insurances in those areas, but a little bit on the edges of where people are working, as opposed to some of maybe the most traditional areas of actuarial science work in the areas of pricing and reserving for life insurance or general insurance in those areas. So we want you to kind of see what's happening in industry. We've selected a nice group of panelists. They are all SOA members. They are all working in industry in the Asia region. And so they will be able to tell you about their personal relevant experience that hopefully will guide and give you insight into what's happening in industry and how you can better prepare your students for that. The presentations, many of them are related to technology, to data analytics, to ESG, and InsurTech, and so on. So I think you'll find this to be an interesting set of presentations. I want to again thank our speakers for taking time out of their work days to join and present today. We really appreciate them doing that. And just remind you as well that there'll be a third faculty webcast will come around in the November-December timeframe. And the focus of that one will be really on best practices sharing among all of you as faculty members. So today's focus is industry. The next one will be best practices in the context of teaching and sharing in that area. So we hope you'll be able to join that. And as a final reminder, this webcast is being recorded, and so we will make sure that it's available on YouTube, so that if you want to listen again, or if you want to share this recording with a colleague who perhaps was not able to be here today, you can do so. So again, thank you for being here. Thank you to Billy. Thank you to our staff team who's put this together and all the speakers. And so I appreciate you being here, and we'll turn it over to the program from here.
Okay, thank you, Andy. I think this would be a great webcast. And now it's time for our next sections. In these sections, our speaker, Ophelia, will share the topic, Future of Actuaries. That's a very important topic. Ophelia is a Deloitte actuarial practice leader for Hong Kong and mainland China. She is a seasoned actuary with more than 20 years of experience in insurance as a consultant and insurance company executive. Throughout her career, she has worked with insurance companies in Asia on a wide range of business problems, including pricing, financial reporting, business planning, actual modeling, M&A, and more recently, of course, IFRS 17 implementation. She is passionate about people and organizations and discussions around the target operating model for finance and actuarial professions, and turning threats brought by new technologies such as AI, I think, into opportunities for actuaries in this world. She is now leading the Finance and Actuarial Transformation Initiative within Deloitte across Asia Pacific, and driving hot topics including generative AI applications in the actuarial space. Now, let's welcome Ophelia on stage. Over to you.
Thank you, Billy. Now I'm just waiting for the deck to be put up, please. Thank you. Okay, well, good evening all. It is a great honor to be invited to present to the SOA faculty this evening. Now, today's main theme is around career options for actuaries. Now, as an actuary who has been practicing for, it's actually 23 years, I'm very glad to see that actuaries nowadays have much wider options than when I started work some 20 years ago. Thanks to those actuaries who have ventured into new areas and acquired new skills with courage and innovation. The next slide, please. Now, so I think it's apt to open today's discussion, like the whole panel discussion, with a quote from a famous actuary, so that to give us some inspiration, like to always evolve ourselves and then to try out the different possibilities. So I have selected this quote from Frank Reddington to prepare ourselves for an interesting discussion today, and where actuaries strive to become more than an actuary in today's world. Okay, the next slide, please. Okay, now, so with our professional training, there are many career options open to actuaries. I would say both within the more traditional areas of practice, such as insurance, as Andy said at the beginning, but also some newer areas. So in today's whole session, I will open by sharing the evolving roles of actuaries within the insurance field, whereas I will let my fellow speakers talk about their experience in the newer areas. Now, I'm also a member of our SOA Asia Employee Council. And so speaking from an employer's perspective, I've seen many examples where very bright young actuaries, they've got flying colors in the early years of their career, but then they get stuck in a position for a very long time. So I think it's worth spending some time to look at a typical career progression and pathways for actuaries, and how to kind of embed the reflections or the lessons learned into our actuarial training, so that we can really embrace the very many possibilities that are open to us. Okay, the next slide, please. Yeah. Okay. Now, the next slides as well. Thank you. Now, as Andy alluded to in the opening, actuaries we have been very active in the insurance field, be it life insurance, property and casualty, health insurance, and pension. Now, in the insurance field, we play a pivotal role in product pricing and reserving, actuarial modeling, that is a key skill set as well, and also financial reporting. We are very active in these different areas. Now, the next slide will show us, actually, with our deep knowledge of the entire insurance value chain, there are immense possibilities for actuaries to go outside like of those roles that I just mentioned to a much wider range of roles within an insurance company. Now, first of all, I think nowadays the actuarial function works much more closely with the finance function. Now, at least in Asia, many chief actuaries and the finance controller, they both report to the CFO. So it's now like a very common organizational structure. And I would say the introduction of IFRS 17, like this new accounting standard, like in Asia. I mean, I know in the US we've got US GAAP LDTI, but at least like the IFRS 17 standard has given this integration between the actuarial and finance functions another push, because the production of the financial statement and the disclosures now require the actuaries and finance people working more closely together to generate the financial statements. And so it is, we have seen like movements where actuaries now getting into some of the important roles in the finance area, such as like business planning, capital management and optimization, and some key roles in financial reporting. Now, other than the finance function, it has also been a natural extension for actuaries to get into the enterprise risk management role, because our training helps us to like have superb skills around measuring and managing risks. And in Asia, at least, many chief risk officers with of insurance companies, they have gone through actuarial training at some stage in their career. Now, related to the second line of defense, the risk function, I've recently had a friend who joined the internal audit function of an insurance company. Now, I think in the insurance audit section, as the third line of defense, there are many actuaries there because we are valued for our knowledge on like the understanding of the whole insurance value chain, like from the front line to like claims and sorry, to underwriting and to the pricing, the product design, and then the back end operations such as claims and customer servicing. Now, and so like the internal audit functions, I mean, they do value this like end-to-end knowledge and also our deep training on like risk identification and proposing different ways of risk mitigation. Now, other than these areas like finance and risk and internal audit that are more adjacent to actuarial, the actuarial like kind of training, I've actually seen actuaries now being present in a wide spectrum of roles within an insurance company and also very active in business leadership roles at the C-suite level. So now I'm going to share like three case studies or examples of like the so-called like more non-traditional roles that actuaries play within an insurance company. Now, the first one relates to product and distribution. Now, I would very much like to share this story with you that like a client of mine, they actually designed a rotation program for actuaries. Now, for pricing actuaries who would like to be promoted to the managerial level, it is actually a requirement for them to join the agency force and work there for a while to get like the new kind of frontline sales exposure. Now, during this time when they are with the agency force, they are actually evaluated like as an agent. Now they report to the head of a district manager. They need to call up like customers to like sales. And they have to kind of like they evaluated like in terms of the kind of number of cases that they pull through and the case size and all that. Now I spoke to one person who took part in the program some years ago. Now he appreciates like very much the opportunity to join the agency force because before getting this exposure from this program, I mean, he was a bit defensive in terms of like any feedback given by the frontline, like the agents, because he would think, okay, I mean, you've got like, if I make the product design and pricing that easy, then we don't probably need like good agents to sell to our customers. But then once he has gone through the actual experience, like by kind of gaining firsthand experience selling to customers, using their sales planning tools, forming the sales narratives, and then actually kind of mingling with the agents and knowing like how they think and how they behave, he thinks that is like valuable inputs into how he goes back to the pricing team and does product design and also pricing. Because before joining this program, like setting the commission rates, like the compensation, it's sort of like, okay, a routine task. But then now with his own exposure and kind of like different levels of difficulties of different products, then he appreciates a bit more as to how to set like the compensation. So I think this is one example where like getting exposure and actually working in the distribution field and kind of bring the experience back to product design and pricing. That is one very valuable experience. Now, the second example I would like to give is in terms of like data analytics. Now, this is with another client of mine. They have recently set up a data analytics team within the finance and actuarial function. Now, this initiative is driven by the CFO, who has got a vision of making the finance and actuarial function an insight generating function of the business so that they can keep giving like business insights and advice to the business to drive performance. Now, the head of the data analytics team is actually a friend of mine. We went to college together. Now, I just kind of like, I will share like the journey that he went through, and then we can take a look at some of the challenges that he encountered as well. So before taking on this role, he wasn't really kind of that into like data science or doing analytics. Now, throughout this journey, he has been successful with setting up this data platform. So it's actually called a finance data platform, where the platform stores different kinds of financial reporting data, but it also connects with other data, such as the customer data and the distribution channel data, so that like more analytics can be performed on the data platform. Now, as the head of the data analytics team, he has to collect user requirements from the different teams and then form use cases to be performed on the data platform. Now, I would say that for this particular company, since the platform has been set up, they have been using it to perform experience studies, and that is done in a much more automated manner. Now, before the platform was launched, experience studies was done in a fairly like manual and also infrequent manner because it takes time to gather the raw data, to cleanse the data, and also to massage them. Now that they have got like the data kind of prepared with much more granularity and also like slice and dice into different angles, it's much easier for the actuaries like within this team to produce different reports and then to provide new perspectives to the business, like for kind of business insights and advice to the different teams. Now, of course, the challenges lie in the fact that like how to acquire the data needed, how to link up the different data sets, how to govern the different data fields, and also kind of like what analytics techniques are out there, like the machine learning and more recently generative AI techniques. Like these are all new skills to actuaries. So I asked him like, how do you actually like start the journey? Now, this guy actually took up like courses in data science, and then he has spent time looking through the different software in the market to learn like what's new in the market, and then which one is useful to the company. And more interestingly, he has hired some data scientists into his team. Now, I asked him like, there is a common perception that like the actuaries and data scientists are we kind of competing professions? How do you differentiate your team from the data science team? Now, his answer was that he himself and the team that he trains up has got abundant like product experience, and he has got this, as I said, the end-to-end insurance knowledge. And so essentially, he is a very well-equipped like insurance expert with data scientists with data science skills. So I think that is the edge that he has achieved like for himself and his team. So I think this team, data analytics, is very highly regarded in the company, and then it's like seen as the future of the finance and actuarial department. Because in the older days, before the setup of this team, the career path or the career planning for people in the department did not include like data analytics. And now data analytics is seen as a specific, like an individual standalone, like kind of path or job family for that particular company. So I think this is one good example to show how actuaries have branched out to the data analytics field, and also like maybe touch on the question about like differentiation between actuaries and data scientists. And the third example that I would like to share is around like the business leadership role. Now, I was reading over the weekend about an interview with the group CEO of AIA. So the group CEO is Lai. Now, for your reference, AIA used to be part of AIG, but then it was spun off after the 2008 financial crisis and got listed in Hong Kong in 2010. Now, it's now a pan-Asia company operating in 18 markets in Asia Pacific. And its market capitalization is amongst like one of the highest in the world in life insurance. Now, I looked through the profile of Yun Song, like kind of through LinkedIn, also the interview that is on the internet. He is actually a member, like a fellow of the Society of Actuaries. And before he lands on this current position, he has got very wide exposures in different markets. So he's like worked in different geographies in over the world. And he has transitioned from an actuary to firstly a CFO, and then to become a business leader with various well-known insurance companies in the world. So with these examples and actuaries branching out into different areas of an insurance company, it is clear that a professional training opens doors to many possibilities. Now, I think we have got a lot of professors on the line today. So how can a young actuary or student like ensure that he has got the widest possibilities when one starts with his or her own career? Now, I think the key is it comes down to understanding like the different skill sets required like for career progression, and also to have like career planning early on. Now, so in the next few slides, I'm going to share with you the typical career progression and pathways for an actuary, and the common challenges that some actuaries may run into. And then we can reflect on some of the lessons learned in terms of how we embed those into our training. Okay, the next slide, please. Thank you. Now, I would categorize the an actuarial career into 4 stages. Now, as a freshman, of course, the apprentice is like a sponge. So he's ready to absorb knowledge from everybody around him. He will spend time developing his technical skills, and then I would imagine he'll be studying towards fellowship at the same time. So this is the stage where I think very, very fast personal growth is often experienced. Now, then in about like 3 to 4 years' time, I would say he will become an active participant, where he may start to look after or to lead like a few junior people at work. He will have his own views on certain topics, and he will continue to deepen his technical skills and knowledge. Now, some people, like the really high-flying performers, they are likely to kind of achieve qualification during this time. So taking their professional and also technical kind of recognition to the next level. Now, then I've seen some bright people, like very, very bright young minds. They become promoted to the manager level very early on in their career. Now, in some of those cases, actually, the managers start to struggle because in the early years of their career, their success is very, very often dependent on his or her own individual ability. But at the manager level, one has to deliver through others. And very often you have to collaborate with people outside of the actuarial function. So how do you work with like other people and then to influence them and draw out like the best potential from the team? This is often not taught in our actuarial training. And so we've seen some managers struggle in this particular at this particular level. So we'll look at some case studies later on, but then bear in mind like we have got like this manager grade as the 3rd stage of our typical career. And lastly, I think some actuaries, they will progress into like a business leadership role with even like a totally different set of skills are needed, like business decision making, business acumen, the internal external network, and also I think to me the most important skills are basically influencing others and also negotiation skills. So I think with this like typical career path in mind, I would like to share two real life examples, like two friends who struggle at work. And I think let's look at the stories and then we can reflect on how we can embed the lessons learned like into our actual training and helping our young actuaries like plan for the career. Yes, next slide, please. Okay, now Dan is a friend of mine. So he's very experienced. He has got like more than 25 years of experience. And when he first started working, he already showed like very high caliber, like very high talent in the area of actuarial modeling. Now he's like been regarded as the master in this particular space for a long time. And he has recently joined a multinational company as the global head of actuarial transformation and is tasked with changing the way that actuaries work with new technology. So that's Dan's background. And the next slide, please. So when I met Dan for dinner like about 6 months ago, he was very excited, telling me that he's now got this new transformation role, and then he has got a new idea like on a new advanced like AI model that he thinks will significantly increase efficiency within the actual department and also increase the predictive capability. Now, and I just recently met him for dinner again and asked him like how he's gone with selling the idea and setting up a project with the company. But then it appears that the project has not been set up and he has not been able to get buy-in on this particular idea. And then I asked him like what happened, and then we discussed. So it appears that like the way that he has been selling the idea to senior management is not the right way. Now, I think a few kind of key takeaways from here. Now, when talking to the CFO about the idea, it looks like he jumped straight into the technical details, talking about like the algorithms within the AI model. It talks about like how the kind of coding works. And then I said to him, like, Dan, this is not how the CFO thinks. Like, you have to think from the CFO lens because he's interested in how this like model of yours will bring business value to the company and whether the costs and benefits are justified. I mean, I also asked Dan, like, if we say that this new model is going to save like a lot of manpower, increase efficiency, would that have like a HR implication? He said, yeah, I've spoken to the head of HR as well and proposed that this will reduce the number of people in the team a lot and to save money for the company. And I said to Dan, well, you have to be a bit more sensitive and empathetic in terms of how to communicate this message, because if like this kind of narratives go out and then people start to worry about like losing their jobs, then this may bring unintended HR consequences and repercussions across the company. And so I think this is one example where even though there are many opportunities like for actuaries, but then the way that we take on like these opportunities and engage with others is often a hurdle for us to kind of fully utilize or fully benefit from the opportunities that are open to us. Now let's look at another story of my friends. So if we go to the next slide, Jim. So again, Jim, very experienced. And then about 8 months ago, he said to me, he was very excited being considered for the chief actuary opening within his company. And then he's very confident about landing the position because he's done pricing, he's done financial reporting, he's done capital management. So he thinks he ticks all the boxes. So again, recently when I met him for dinner, he said with disappointment that he did not get the job. Now, the CFO, Susan, actually hired someone externally to fill the position. Now, if we go to the next slide, then we will see that actually Jim totally missed the point because he sells his technical excellence to Susan, the CFO, but then in fact, the company is looking for business leadership. So Susan quite frankly said to Jim that he's got a reputation of not being easy to work with. I mean, this comment has come from other departments like distribution, from marketing, and so this reputation for not being easy to work with and also not stepping up to lead the team in difficult times, those qualities are not considered the right like business leadership qualities. And so Jim did not land on the position. And the sad thing is that he was not aware of these kind of skill requirements before he was even considering like how he could increase his chances of getting the position. If we go to the next slide, so I've summarized the different lessons learned into like a few areas for us to reflect upon actual training. So of course, the skill sets that we need to acquire, like especially for young actuaries, the different facets or the different phases of an actuary. So as we progress, like our role becomes a bit different, and also how to plan for the future. So if we go down to the next page, I'm very aware of the time. So for the skill set, I'll leave it to you to read. But then I think the key message here is that a lot of young actuaries are kind of more focused on developing the technical skills in the early years. But then as you progress, then it's important to develop skills in like business acumen and communication. Now, the next slide is about like the different phases of an actuary, but then I will leave it to you to read in the interest of time. But then I would very much like to close by looking at the next slide, which is about the career planning, because I know we've got a lot of professors on the line. And this is one example of a career planning tool that I created with a company a few years ago, which shows the different career paths of an actuary within the actuarial department. And it talks about the minimum requirements for progression and also the success factors for the current role. Now, this tool works by like clicking into the different boxes and seeing like what the requirements are and then how do you move across to the other departments in the company. So this is where I will end because of the interest of the time, but then I think the pack will be shared with the audience. Billy, just checking, is it like the kind of about time?
Yeah, thank you, Ophelia. Yeah, I think we have 2 more minutes and can allow a couple of questions. Actually, I find one in the Q&A boxes, so others feel free to add. So, but before I ask the question, I think I like the examples of Dan a lot. I think it's very classic actuary, what happened, and then definitely we can learn a bit more on how to get things done. So the question here is. Thanks for your sharing. It was great to learn about the dynamic role as an actuary, being able to progress in the executive roles and pivot into other related roles. Can you, Ophelia, also share some examples of how the industry, okay, like banking, financial reporting, etc., get into the actuary? So from the other way, so other people going to the actuary, do you have some example of that? Yeah, I think that's the question. Yeah.
Right. So from other industries going into the actuarial role. Yes, indeed. I think, well, maybe not so much someone from the industry, like banking industry going into the actuarial role. But in fact, a lot of my team members, when they studied in college, they actually did not study actual science or they did not study statistics or mathematics. Actually, I've got a few friends who study like, let's say, psychology. And one is actually a botanist, and then becoming an actuary. Now, this is before they kind of like they did not join another industry. They studied those kind of specialties, but then they kind of joined the insurance industry. So I think it's kind of rarer for someone from like other industries joining insurance. But then I have seen many examples of people studying other domains like psychology, and other disciplines like joining the actual profession. I think that helps with like the perspective because psychology, because a lot of what we do, we need to understand like the behavior of our customers, the behavior of the agents and our distributors. So I think the exposure is actually very helpful.
Wow, thank you, Ophelia. Maybe one more quick question for myself, actually. So, given you are working in a one of the big four, you met a lot of accountants. I'm aware that there's a lot of evolving roles for actuaries. Do you feel it happen the same for the accountants or other profession as well?
Yes, definitely, definitely. In fact, our accounting colleagues, they do like a wide range of work. Just one example. I mean, the kind of helping companies go for IPO, get listed. That is like one major thing that like our accounting colleagues do. I think that is you need to kind of understand like how kind of listing work in the different industries. So I think it's not just the accounting nature itself, but to understand how that applies to the different industries and the industry knowledge. That is like one thing that our other colleagues, our accounting colleagues, are getting into as well.
Thank you. Your presentation. So, okay, sorry. Thank you, Ophelia. Now it's time for our next sessions. In this sessions, Horng, Cheng, and Timothy will share topic on charting the future, actual practice in general insurance and ESG. Please join me. Welcome the first speaker for this section, Horng Cheng. He is the appointed actuaries of Alliance General Insurance Company in Malaysia. He has over a decade of experience in general insurance field and encompassing insurance liability evaluations, rate making, ICAAP, due diligence for M&A, reinsurance purchase analysis, as well as the IFRS 17 reporting. Horng Cheng also served as a council member of the Malaysia Motor Insurance Pool and as a member of the Industry Advisory Panel at Taylor's Business School and University of Malaya. He actively volunteers for the Actuarial Society of Malaysia and the Societies of Actuaries, promoting actual profession to students and supports various development initiatives. He's also a member of SOA's Greater Asia Committee. He will share the actual practice in general insurance industry from the direct insurer perspective. So over to you.
Thanks, Billy. Sorry, just give me a second. Billy, can you see the slide?
Yes, perfect.
Okay. Yep. Thanks, Billy, for the introduction. Yep. As mentioned by Billy, this session will be co-presented by myself and Timothy. For myself, I'll cover the general insurance aspect of the actual practices, whereas Timothy will cover the ESG part. So my sharing will take about 20-25 minutes and then followed by Timothy's session. And then after that, we will have a joint Q&A session. So in the meantime, if you have any questions, feel free to type your questions in the chat box. Okay, some formalities. So these are the presentation is purely my own personal view. It doesn't represent SOA or the organization that I represent. Okay, with that, let me start my sharing today. So I'll talk about general insurance and what actuaries do in in general insurance. So firstly, what's general insurance? General insurance, as the name suggests, it basically covers everything that's non-life insurance. So in some people also call general insurance property and casualty insurance. So it really is about covering damage to properties and the liabilities arising from various activities. So general insurance are typically 1 year or short duration coverage. Unlike life insurance where you buy a policy and then you renew for like 30 years, 50 years, or sometimes whole life insurance, you basically renew like kind of forever. General insurance, typically it's a 1 year policy, but there are also exceptions. For example, like travel insurance where you buy for your travel period, or marine cargo insurance where you buy for the duration of the shipping. There's also longer duration policies, such as like those engineering contractor or risk policies that tie to the duration of the construction. So in most cases, general insurance are shorter in duration. They are annual renewable, and I'll give you some example of general insurance. The most common general insurance I think that's available in almost I think in all markets is motor insurance. Usually it's one of the main product for most jurisdiction because it's usually a compulsory thing for you to be able to drive legally on the road. Motor insurance typically cover the damage to your insured vehicle and also the liability that's arising from the use of vehicle. When the insured person got into accident, he hit someone or other person's vehicle or property, that's when the motor insurance provide the coverage. The other common example is home insurance. So basically, insureds or cover the insured home house for damages from, say, fire, windstorm, flood, earthquake, and so on. And I've also mentioned about travel insurance earlier. So travel insurance typically covers things like medical emergency during a trip. It covers trip cancellation and so on. We also have general insurance also cover a wide range of commercial insurance. For example, contractor or risk cover, which covers like the construction of, say, a building, bridge, and so on. Yeah, and we also have different type of liabilities covering like various occupation and also personal liability. So in short, general insurance has a wide range of products, cover a wide range of interests. Basically anything that's non-life related, it falls under the umbrella of general insurance. Okay, so now that we have a high-level understanding of general insurance, let's look at what actuaries typically do in a general insurance company or an insurance company. So when we talk about actuarial department in an insurance company, usually the focus is really about, or we are actually referring to the actuarial function, or some call the corporate actuarial function. So what is the main role of actuaries in the actuarial department or corporate actuarial function? The first and foremost, it's really about computing the technical reserve. So this is also known as reserving, something that you may have come across in the syllabus or in the exams, actual exams. So reserving. What is reserving? Reserving is really about estimating the future unpaid claims and also estimating the future claims and expense payment arising from the business or policy that an insurance company has written. The idea or the goal is really to estimate how much potential liability an insurance company have, and also this will allow the insurance company to set aside sufficient money or sufficient reserve to meet their future obligation when it's due. So that is the main function of actuaries in the actuarial department. And in most countries, when there's change in regulation or the introduction of the need to have an actuary in an insurance company, usually they will usually start with the actuarial function, and the focus is really about the computation of the insurance liability. With the actuarial function, there's also the regulatory and financial reporting role. I think earlier Ophelia also covered about IFRS 17. So increasingly with the implementation of IFRS 17, actuaries are getting more and more involved in the financial reporting. Previously, I think the involvement in actuaries in most instances, it's really for general insurance actuaries, it's really about providing the IBNR, incurred but not reported, estimates to the finance colleague, and the finance colleague will pretty much prepare the financial statement on their own. But increasingly with IFRS 17, there is also involvement from actuaries in various item of the financial statement, and also the various disclosure requirement. Just to take general insurance, for example, although like most of the business are PAA eligible, there are also a lot of requirement for inputs from actuaries, such as providing the liability for incurred claims estimates, also providing the CSM estimates, and also with regards to the disclosure requirement, we need to show or explain the movement of various estimates. So more and more actuaries are involved in financial reporting. And thirdly, in most jurisdictions, the regulator usually mandate that the appointed actuary or the signing actuary produce the financial condition report, or some call it the actual function report. Basically, it's an analysis or review of various functions in the company, such as like the underwriting policy of the company, pricing policy of the company, adequacy of the reinsurance arrangement, the asset liability management, and so on. The idea is to get actuaries to review or provide advice to the senior management or the board of directors. What are the things or events or anything that may potentially affect the financial condition of the company, so that informed decision can be taken. So that's mainly on the actual function. Next, I'll move on to rate making and pricing. So rate making and pricing is also one of the core traditional actual role. As the name suggests, I think pricing or rate making is really about the process of determining the insurance premium. So unlike pricing for product and services where the cost is known upfront, let's say, for example, I want to sell a car, or I want to sell a phone, the manufacturing cost is known upfront, and I'll just add in the distribution cost, the profit margin that I want, and the cost or the price is known with certainty before a product or services is being provided. Unfortunately for insurance, basically that we don't have such luxury. So the real cost of the insurance coverage is only known after the coverage has been provided. So if there's no claim, then it's a profit to the company. If there's a lot of claims, then the insurance company will suffer a loss. So the role of actuaries in rate making or pricing, it's really coming out with the technical premium. So what is the technical premium? Technical premium is really about a premium rate or amount that is sufficient to cover the cost of insurance, meaning to provide to pay for the losses, and also to cover the expenses related to selling the insurance, the management expenses of the company, and also provide a reasonable return to the shareholders. So this is the so-called technical premium. Pricing actuaries, the first task is really to come up with the technical premium. So once the technical premium is computed, the job is not done yet. So then the next steps typically come in, where the pricing actuary will work together with different stakeholders in the company, typically the sales colleagues and the underwriting colleagues and the other various functions to determine the commercial premium. So the commercial premium can be different from the technical premium. Why is this the case? So sometimes if there is certain business strategy to grow in certain segment, the company may decide to price at a lower profit margin, or sometimes even at a loss. Or if there's a certain special consideration, the commercial premium or the final premium charged to the client can be different from the technical premium. But the role of an actuary is really to help the company make an informed decision. So you know how much is required to insure a risk, and then you make an informed decision how much you want to charge, whether you want to charge a technical premium, or if you are charging at a loss, charging a premium lower than technical premium, you know you're going to suffer a loss, whether you have the capital to withstand the loss, and so on. So the idea is really to help make an informed decision. Actuaries are also involved in rate filing. So for certain line of business, certain products, the regulator may mandate that the insurance company file their rates to the regulators. So meaning you tell the you tell the regulator how much you are charging, how you arrive at the premium, what are the justification, consideration, and so on. And yeah. So on top of that, there's also this price watch or monitoring work that is done by actuaries. So what it means is once the pricing is done, the product is launched, the work is not done yet. So that it also requires a constant monitoring. So for example, you check whether you are growing as per plan. So let's say there's a target of X amount, whether you have achieved the target within a certain period of time, or usually you have some checkpoints to see whether how is the actual experience tracking against the plan. So if, let's say, you have a target area where you want to grow, but the growth is not as planned, or there are certain segments that you are trying to avoid, and you see that the growth is very strong in that segment, then that monitoring will provide you some early warning sign where you should tweak your commercial premium to in order for you to make that adjustment so that you can meet the business plan. So these are some of the key roles of responsibilities of pricing actuaries in the pricing function. So the third one, and also a traditional actuarial role, I would say, is the enterprise risk management. So enterprise risk management, it's really the solvency regime differs by countries. So for example, in Europe, we have Solvency II, and in US, you have RBC. And in many countries in Asia, Malaysia included, we have RBC, Risk-Based Capital Framework. Although the regime is different, the name is different, but ultimately they are trying to achieve the same thing. The objective is the same. It's really to have a more objective way to measure the health of an insurance company. When I say the health of an insurance company, I'm referring to the solvency of the company, whether the company will go bankrupt or not in the next day. So what it means is really if a company has a high solvency ratio, it means that it has more capacity to absorb and withstand unfavorable event. It can be high claims. It can be due to a severe catastrophic loss. It can be due to a fluctuation in the financial market where your investment, you lost a lot of money from your investment and so on. So the higher the capital level of a company, the better they can withstand all these negative events and be able to meet its obligation to its policyholder, means pay claims when it's due. But we also have to be careful because holding excess capital, it's unfavorable to shareholders because your shareholders typically requires a certain return for the capital that they put in. So if you have very high capital but generating a moderate return, then your shareholder won't be happy. So I think this is where the actuaries can fit in the role and help balance the two. So actuaries typically they're involved in solvency assessment. So solvency assessment is basically just about measuring the financial or computing or estimating the solvency position of a company under normal scenario or under stress scenario. There's also this ICAP process, internal capital adequacy process, assessment process. So usually on top of the regulatory or minimum solvency requirement, insurers are typically will do their own assessment in order to identify capital level that is most optimal for their risk appetite and risk profile. So if you want to invest in higher risk investments such as equity to get higher investment return, or if you want to write in certain business segment that may be more prone to large loss, then you will have to set aside higher capital level. But ultimately, it's really to make an informed decision about how best to balance the risk appetite and the business objective of the company. And also, the other thing that actuaries in ERM involved in is the top risk assessment. So this is a regular periodic assessment of the potential event, quantitative or non-quantitative, that may affect the company. So for example, previously you may have like COVID, or you have like or more recently it could be like inflation, how high inflation may affect the company's claims or business operation and so on. So it's really to identify and provide recommendation so that early action can be taken to minimize or to avoid any significant negative impact to the company. So sometimes actuaries also do ad hoc requests, ad hoc stress test scenario at the request of regulators or the management to better understand how certain event may affect the solvency position of the company. And increasingly in recent years, I've observed more and more actuaries are involved in portfolio management. So this is kind of a role that's in between pricing and underwriting role. So usually an actuary works very closely with the underwriters and the pricing colleagues in order to monitor the performance by different segments. So commonly, they look at it from a distribution channel or customer segment, whether it's like retail customer, commercial customer, and to identify whether these segments are profitable or there are pockets of areas that require some improvement. So for general insurance, you typically look at what's the growth, what's the combined ratio, meaning how profitable is the business, and then you try to slice and dice to look at whether there's any pockets of area where your market share is low but it's profitable, so you want to grow that segment, or if your market share is high but it's unprofitable, then you may want to trim that business, meaning you try you reprice it upward or you impose a more stringent underwriting terms when it comes to renewal. So some of the levers that you can pull is really about working closely with the pricing colleagues. So for example, to increase price or to work with underwriters to change the terms and condition for accepting the business. And also if there are certain areas that you want to grow or that you want to shrink, there's also potential to adjust the incentive to the distributor. So you may increase or reduce the incentive for the agents. Obviously, if they have a higher incentive, then it's more likely for the agents to sell. But if there's certain segment that you want to avoid or reduce, then you can do that by adjusting the compensation downward. So ultimately, the portfolio management is really about getting to know your business better and then to grow the good business and to trim the bad business. And because actuaries are involved in various area of the insurance company, so actuaries are typically familiar with, let's say, capital requirement, the different financial reporting requirement, maybe pricing and also reserving. So actuaries are typically involved in business plan in insurance company. And sometimes when it comes to merger and acquisition, the role of actuary is also very prominent because, for example, if you want to acquire another insurance company, the first thing or the main liability portion is usually the insurance liability. So this is when typically the reserving actuary will review the reserving practices or the insurance liability of the other companies to have a better idea of like what you are getting yourself into, and also with that put a value to the deal. And also partnership deals. Sometimes you have different partnership deals. For example, in Malaysia, it's common to have like a bank assurance partnership. So you pay a certain fees to the banks to get their business, but this requires quite a substantial in upfront investment. So you have to run the scenarios like what's the return of this business and whether it's worth it or not. Okay. The other thing, it's really it's something that is more recent, and I've seen this quite a bit in my organization and also in our competitors, where different departments in the companies are recruiting or getting more actuarials, actuarial graduates, actuaries to join them to work on different things. For example, sales and distribution, you get the actuaries to do the analysis on cross-selling, upselling. So for example, if you do a cold call, telemarketing cold call, I think the typical success rate is maybe 1%. But if you can identify certain segments of people who are more likely to buy, and then you improve the efficiency by 2 to 3 times. And that translate over the long run, it translates to a significant higher increase in the in the production of the GWP, the premium that you get. Also, when it comes to campaign and incentive, you want to get the most out of the return, the investment you made. So you want to analyze what kind of incentive you can provide and what kind of return in the sense of usually it's in the form of the production GWP or also the expected profit that you get. And sometimes for agents, you can also help identify the agent persona of certain maybe smaller agents, they require certain type of training, or for bigger agents, they may need certain type of a different type of support, or maybe you can even give them a bit more authority to write bigger business. So this is really about analyzing the different needs of different people and try to either make the company more profitable or make the operation more efficient. And increasingly, actuaries are also involved in supporting the claims function, for example, analyzing the third-party provider. So you may benchmark or you may compare different third-party provider, what kind of value they're providing, how are they comparing against the peers, and with that make some adjustment either to if they are lagging behind, maybe have that discussion to see how they can improve their performance and so on, and also to track like leakages and claims, meaning we pay higher than what it's supposed to be, or to identify fraud. Yeah, I think that's all I wanted to cover for general insurance, actual practice in general insurance. I'll save the Q&A to after Timothy's presentation. Billy, I pass back to you.
Yeah, thank you, Horng. Yeah. Thank you very much. I think we can save the questions after Timothy has presented. Of course, feel free to ask questions in the question box. Now, let me introduce you the next speaker of this section, Timothy. Timothy is a sustainability manager in HSBC and currently focused on climate risk and scenario analysis in Asia Pacific region. He is responsible to conduct stress testing and development strategies on portfolios under different climate scenarios, covering physical and transition risks. Prior to that, he has worked in consultancies such as Global Scan, PwC, and Mercer. He has worked on sustainability projects, including net zero strategies, predictive analytics on ESG trends, and S&P rating exercise. Timothy is a steering member of the SOA Catastrophe and Climate Research Committee and has regularly sharing latest findings on climate risk and ESG in articles and industry forums. Timothy will share the topic on emerging considerations of climate risk in the financial industry. So, Timothy, over to you.
Thank you, Billy. Let me quickly share my screen. Yep. Good morning, everyone. I'm Timothy. Thank you, SOA, for inviting me to be here. I think it's really interesting that we got a lot of practitioners as well in this group that we can talk about different areas of like non-traditional actuarial like working areas. So I would really love to talk about an area which I'm really passionate about. Is about sustainability and climate risk. So I'm currently working in HSBC on climate strategy and scenario analysis. I'm also part of the steering committee for the SOA Catastrophe and Climate Research Program. I think this is really one of the few groups in SOA which are really looking into climate and sustainability. I think we started like a few years ago for this very emerging topic. For some personal background, I graduated in CHK some years back in insurance, financial actuarial analysis. So really happy to be here to talk to you all, share a little bit about climate and how our next generation of actuaries could be joining to help with this cause. So maybe first of all, just a little bit background on like what does actually climate risk means for insurance and actuaries. So I think the first thing that a lot of people think about would be really about like the extreme weather events, like what we see on the screen, flooding, wildfire, like typhoons, etc. So these will be what we so-called physical risks, where we can see a lot of destructions to asset, like deaths caused by natural catastrophes. These are also risks that closely looked by general insurance and life insurance as well. But the other side of physical risk will be really talking about transition risk, which is the second point. This transition risk is really about when the society is transitioning to a like greener or cleaner society. So there will be a lot of like different shifts in the society, including like removing some of the high carbon emission industries like oil and gas or power generation, etc. So there will be a lot of investment losses coming from those industry, or if the governments are going to implement carbon tax or other types of restrictions, there will be transition risk implied from all these kind of policy changes. I think the third thing that we can talk about is really on reputational risk. I think a lot of people, if you flip through the news, there are always some news around like greenwashing or like some investment products saying that they are like sustainability investment or ESG investment. But turns out if you look into their constitute funds, maybe they're not really that green, or they may not be like up to their claims. So there will be a risk around like failure to meet certain expectations from these kind of products, like in pension or investments in life insurance or general insurance, from the customers or from the government, society, etc. So there also could be regulatory risk. There are a lot of requirements now for companies to disclose climate risk on your operation, or like if you have done any climate stress testing, you may also want to disclose it. So we are expecting there will be more mandatory requirements for insurers to consider climate risk in your daily operation. So there are a lot of ways that climate risks interact with the insurance industry. I think to stress a little bit about the point, how important that climate risk is for insurance. Actually, there is an annual survey of emerging risk key findings that's coming from the SOA Research Institution and also cooperating with CAS. We have done it for, I think, the 17 years now in 2024. And as you can see from the table, every year we ask actuaries and risk professionals around the world on like really what is the top emerging risks you think in your daily work. And since 2020, we can see climate change is really getting the top place. Of course, there will be like pandemics, wars, cyber risks, etc. But we can see that coming out since 2020, climate risk is always the top emerging risk. And although it may not be really the current, really top current risk, we can see that it's really emerging, because we expect that the impact from climate change will be keep worsening in the future. And there could be like some unforeseeable ways that they can impact, whether it's our health, whether it's our society, policies, etc. So climate change is really important for actuaries and in the insurance industry. I think this leads to my next slide, which is really about a lot of like new opportunities for actuaries to get involved in the ESG or climate field. Like if we only talk about the work opportunities, there are like actually a lot of new insurance products coming out, like climate parametric insurance, where I think a very good example, which also very recently in Hong Kong, AXA, they have just launched a product which is a type of parametric insurance, which they call a heat wave insurance. So if the temperature in Hong Kong is higher than 36 degrees for consecutive 3 days, then they will be paying out to some outdoor workers for like heat relief measures or something. So these kind of new products that we see coming from extreme heat, coming from like different extreme weather events are very interesting, and they require actuaries skill set to look into like the trends of like the temperature and how to price this type of new products. Other than new products, I think climate risk mitigation is also something that is very important. No matter it's under the framework of enterprise risk management or like looking as a standalone risk. I think a lot of like reinsurers, consultancies, they are advising a lot of clients in the insurance or their clients on how to look into climate risk, how to project them, how to be prepared when climate risk is getting more serious. I think climate stress testing is also one of the good way to assess climate risk and to ultimately leading to some mitigation actions, which I could talk a little bit further in later slides. Also, as I said before, there are increasing regulatory pressure, a lot of disclosure required for companies. We can see actually some leading insurers, they have already releasing a lot of information around their climate risk and opportunities in their annual reports. But also there are also often some regulatory pressures coming, especially like in Hong Kong, Singapore, Malaysia. There are a lot more pressure coming from regulator. I think due to all these like new opportunities, new pressure, there are a lot of focus in the SOA and the whole actuarial community. Not to say very far, like the SOA Climate and Catastrophe Research Committee that I'm in, we often have a lot of research papers around the latest climate trends. We collaborate with a lot of different stakeholders in the society to make sure that we are well prepared for climate change. There's also a new SOA Climate Risk Certificate Program. Yes, it's another exam. Like predictive analytics program, I think climate risk certificate program is, I think we'll just launch it this year. There will be a lot of like information around how, for example, life, general insurance, pensions, retirement, how these traditional, more traditional insurers interact with climate risk and how we can better prepare for them. So there's a new certificate program from SOA. Within other actuarial societies like CAS, CIA, etc., we often collaborate together. We have our Actuaries, Climate Index, etc. So I think we have a lot of new resources coming from SOA and the whole actuarial community. And I think it's up to the academia, like universities, to really talk to the younger generation, because the younger generation are really more concerned about climate change, and I think that they are more willing to solve climate change as a problem as it remains as one of the biggest challenges around the world. So let me just take around like 10 minutes to quickly talk about like what I do daily, or like how usually companies or insurers can work on climate risk assessment or climate stress testing. So this is a case study where if we want to do a climate scenario analysis for no matter is like the investment book inside insurer, investment or your liability books, etc. We may need to consider like a range of different climate scenarios in the future, as we are really not sure like how climate change will evolve, whether the companies, whether the society or governments, how fast they would be like taking actions. So there could be like different trajectories like you see on the graph. Like there could be greener situation where we can reach net zero. You can see the carbon emissions globally keeps going down. like these will be more like greener scenarios, which we expect that the companies will be decarbonizing. The countries which are committed to like carbon neutrality, like for example by 2050 or 2060, they will be upholding their promises. And we can see that there will be a lot of climate policies like carbon tax, or like there will be restrictions on high emission industries like fossil fuels, like oil and gas, etc. So we can see will be some shifts in the sectors in the economy. And there will be, of course, looking into some hotter scenarios, like the hothouse scenarios, where we don't really expect a lot of like new changes coming from the regulators, and we see the carbon emissions still going up. The temperature, of course, will still go up, maybe due to like economy concerns, recession, that they decided to like move on with only the current climate policies that we have. So after looking into different types of scenarios, we can apply these scenarios to our, no matter it's investment book or liability book, etc. The scenarios that you're looking right now in front of the screen is sourced from NGFS, which is the network of central banks and supervisors for greening the financial system. So why we decided to talk about these scenarios is because these scenarios are often like required by the regulators in some regulatory climate stress tests in the financial industries, like Hong Kong HKMA, like Singapore, like Malaysia. They usually leverage this type of NGFS scenarios, which are actually available online, free for everyone to download. And I think these will be very interesting if we are using this for some case studies with students, or just understanding, like, for example, how temperature or how different scenarios will change, for example, GDP or different economics parameters, and ultimately how it impacts insurance. I think after we got these kind of scenario data and set up, the next step was really going to put these scenario data into the risk modeling and see how it impacts our book. I think this physical risk modeling is actually the nature catastrophe modeling, NatCat model, will be very familiar for the GI practitioners, because they really look very closely into this. Of course, like there are like different types of extreme weather events like typhoons, earthquakes, heat wave, etc. And what we usually do is to look into like how the increase in rainfall, how the increase in temperature will be translating into different parameters, like what's the increased frequency or what's the increased severity of these types of extreme weather events. Like, will there be more flooding, more wildfire to our clients, to our book, and how would it impact our like claim experience in the future? We will, in this NatCat modeling, we will also look into, like, for example, like increasing these type of events, how would it, of course, lead to direct asset damage, like coming from these weather events, but also like business interruption that will be leading to also some type of economic loss to our clients. So there are a lot of like examining like what asset type you're looking at, like what will be the restoration cost, or like what will be the duration of business interruption, etc. Doing this type of like extreme weather events. I think these exercises, of course, like very useful for general insurance, but even for life insurance or for pension like investments, if you're really heavily invest in like physical assets, like for example real estate or other types of factories, etc., then we may also need to conduct like NatCat modeling to these kind of like exposure to understand the impact from these kind of weather events. Other than like physical risk, of course, transition risk is another aspect. I think this is like sort of less known, but I think it's equally important, because in some of the like sort of the greener scenarios we are looking at, like we are expecting carbon tax to be coming. Like for a matter of fact, like carbon tax has been introduced in Europe and also some other markets in the world. And if carbon tax is more like generally applied to many countries, or if the government is going to intervene to really achieve the carbon neutrality, then if you are investing a lot in these kind of high carbon intensive industries like minings, metals, non-renewables, then we will expect that there will be corresponding investment loss coming out from this industry, no matter it is like the equity value, no matter it's like the bonds portfolio, whether there will be downgrades or defaults. If they have, like, if the clients or the invested assets that they're suffering a lot from carbon tax, carbon costs, or like they're forced to be transitioned, etc., or like they're newcomers in the industry where the traditional ones cannot like really beat them. So for context, you can look at the table below. Like these are some of the key sectors affected by climate transition risk, suggested by the United Nations. As you can see, for example, oil and gas, there will be really high emission costs coming. And then even if they want to transition to renewables, there will be very high CapEx, which is like capital expenditure, to let them to invest in newer types of energy sources, etc. And I think similar situation apply to like power generations, metals and minings, some industrial heavy industry, etc., etc. To put it in a more concrete way as well, this slide, like, I'm mainly going to quickly show you some results coming from the regulatory climate stress test. The reason why I picked the example in the UK is because like the Bank of England's actually they initiate the world almost the first industry-wide climate stress test for insurers back in 2021, and they have actually released some of the consolidated results coming from the insurers in the UK. So you can see there are some concrete numbers, like on the left, the insurer's equity investment loss, like at year 30, because usually for climate scenarios, we look into a very longer time frame, like 2050 or even 2060, because that's the time where the countries should be fulfilling their carbon neutrality commitment, and we will see like almost the full impact of the climate policies. So maybe at year 30, we are expecting seeing like negative 50% or even up to 70% in some of the equity investment losses in like petroleum, natural gas, like heavy industries, etc. I think on the right, you can see a lot of like impact coming out from physical risk scenarios where tropical cyclones, wildfire, inland flood will really lead to additional loss on their liabilities. Maybe they have like more claims, etc., coming from like flooding, cyclones, etc. So these are like really a good reference point to see how to solidify the results coming out from these climate scenarios and what really actual impact bringing to the insurers. I think one very interesting and useful report coming out from our SOA Research Institute for Catastrophe and Climate is this report, which we published last year. We actually, like the whole research team, would reach out to rating agencies like large insurers and asset management firms to understand really like what are their plans for climate risk mitigations, like where the insurers are in for climate risk, climate change analysis, etc. And we extract quite a lot of insights coming out from like large insurers, like reinsurers, especially like insurers who are coming or located in Europe, where like actually in the European Union, like the regulators, they are really placing a high emphasis on climate risk evaluation and reporting. So I really encourage you, if you are interested or the students are interested, go to our catastrophe and climate research website or this link. You can freely download our report. I think a really quick highlight will be that there are like a lot of ways that the actuaries can really identify, assess, and quantify climate risk. I think the first way that the actuaries can do is really to do quantitative modeling, which is like you look into historical relationship between like climate factors like temperature or like rainfall and how it will correlate to the return or like correlate to the liability, etc. So they do a lot of simulation, they do a lot of like modeling, like regression, etc., to understand the historical relationship and try to project into the future. So this will be the first way. The second way, there are companies we interviewed. They have been looking into it through a carbon footprint methodology. They may be for life insurer or they will look into their investment portfolio, and they look into, for example, bond or equity issuers. They look into their sustainability report or annual report. Usually they would disclose like how much like carbon emission they have every year. So they will just look into their portfolio and understand, oh, if you are invested in these type of companies, and if these companies really emit a lot carbon emission every year, then it means that they're pretty risky in terms of climate transition risk. So through this way, they can like sort of monitor their portfolio transition risk exposure, and they may lead to some mitigation action, like they may divest from certain clients, or they may like invest more in other clients, etc. The third common way we see is really talking about climate scenario analysis, or climate like VAR, the value at risk frameworks. I think similar to what we have discussed just now, it's really going to do climate scenario analysis and really going to estimate the amount of loss coming out from these scenarios. Some companies also leverage third-party ratings, assessments, or other consultancies. They will just like they will simply ask these private firms like MSCI or Arctic Finance to look into their investment portfolio, and they will give, and the consultants or the vendors will give them ratings, will give them advice on this ratings or assessments. Probably because they don't really have a lot of like expertise inside the insurers or inside the company. That's why they leverage private firms. And also private firms, they got like better data, they are more concentrated, they're experts in doing this type of stuff as well. I think only one or two of the more advanced companies, they have really their in-house ESG metrics. They look into not only about carbon footprint, but also they look into natural capital, like pollution, waste, different types of ESG metrics, etc., to give a more accurate assessment on how these clients or this particular investment will be doing in the upcoming future as well. I think ultimately, after all these kind of strategies like risk, scenario analysis, or risk assessments, I think that of course the end goal will be doing some mitigation actions to prepare for the future. There's some news clippings on like from some reinsurers or some like insurance companies. They may be cutting coverage for certain fossil fuels projects, less investment in these type of sectors. Or they may also announce like net zero plan or transition goals by a certain year. So I think these will be really some of the strategy works that actuaries could be influencing, coming up from all these calculations, all these models. They are good advisors to the companies to understand like how the company can do in terms of long-term strategies for climate change or investment, etc. I think just final 2 or 3 minutes, let me quickly also introduce our research program in more detail. We are sort of under SOA Research Institute, so we got funding from the SOA, and each year we create new projects, new research projects, new ideas, and we collaborate with different like industry consultants. Like we hire consultants, we hire working professional. Of course, we work a lot with academia, we work a lot with professors, researchers, to help us understand like the latest impact from like catastrophe events, like climate patterns, and how it impact our insurance industry, etc. So I really recommend to go to our website, or if the students are interested, there are a lot of like different podcasts, newsletters, or like essays from like sustainable development goals, like data sources, climate change risk on retirement, health, etc., etc. So I think these are really useful and free resources for our actuarial community that I really recommend students and professors to go and check them out. And this is just a basic example of what we have consolidated, and some books, research, and other papers. So please feel free to go to the website to have a look. I hope these short sessions will give you like some ideas on how actuaries contribute to climate change. And if students are interested, we can sort of kickstart this conversation, and hopefully we'll see more actuarial students like more interested in this topic and join us. Thank you, and let's talk about any questions that you may have.
Okay, thank you, Timothy.
Thank you.
I think ESG definitely is a very big topic for the future, and I think this is I think we heard a lot from Timothy just now. So I'd like to bring Cheng back into the stage. We did receive a questions from the participants. Again, I think feel free to put more questions, or I will take the time to ask my own. Sorry, so I put the questions online here. It's a Duma from Indonesia. Of course, he thanks Cheng and Timothy for the presentation relating to General Insurance and ESG. His question is regarding the implementations of ESG in different industries in different countries. Different countries have their own policy regarding different industry operating in their country. Ensure to also the kind of characteristic of each country in governing and making policy relating to the operations and different industry in their countries, which are dependent on the characteristics of the countries. And global insurance company need to take into account this matter and not just pressuring a certain country to obey a global and global that's question about a global and local country, and penalize a country if it does not comply to the global standard. In particular, the global standard also need to be evaluated whether it's not used to implement certain agendas of certain countries to certain groups. Okay, so I'm not sure, maybe Timothy can start first. I'm not sure, Cheng, you can add a little bit later. Okay, over to you, Timothy.
Yep. Thank you, Billy. Thank you for this question. I think this is why we got like participants or panelists coming from different countries and markets as well. I think climate policies, of course, is very different from each market, and each regulator have a different approach to it. I think, for example, the climate scenario that I just mentioned from NGFS, although they are global institutions, they have actually parameters for each country breaking down, so that we are not going to apply, for example, a carbon tax in Europe to Singapore or Malaysia or Hong Kong. Of course, we need to take into account of like local policies and when predictions. Also, that's why, like, if you are doing a climate risk or climate stress test, that we really need to look into each market and really understand what's the trajectory, what's the local thinking about, or whether like these type of climate policies really making sense to them. So that we require a lot of discussion, expert panels, and this process won't be just like a black box calculation or something that you can do it in your own. You need to talk to the locals, you know, make sure that this is a well-planned project to take care of like local agendas and local policies as well. Yeah.
Okay, thank you, Timothy. Cheng, you got two more points to add, or?
Sure, just maybe one more point. I think, yeah, with regards to the global standard, I think this is also something I feel personally. And I think, for example, Malaysia is an oil producing company. So yeah, we produce quite a fair bit of fossil fuel. So when it comes to ESG topics, sometimes it's a bit tricky when there's global standard and your country is an oil producing country. So I think it's really about engagement, having that conversation. As long as I think that this oil producing company, they have like a concrete plan to move towards carbon neutral, I think we should leave that option open rather than a one size fit all. Yeah, that's my 2 cents.
Right. Yeah. Thank you, Cheng. Yeah. I think that's just good questions. Although I think today's topic more about the actuarial career, so I can go back a bit to the actuarial career question, which I do have in mind, like Cheng and Timothy. That definitely I think the more traditional insurance is around life insurance or sometimes pension, etc. Like GI and ESG, definitely a little bit new area. Can you just share a bit for actual students if they want to go into the GI or like to go to ESG, Careers, etc. What advice you would give to them if they want to try something new? I'm not sure. Timothy, can you go first?
Okay. I think first of all, encourage the students to read more news. I think we don't really have a lot of, for example, for climate risk, it's a bit different because I think students, they are very familiar with mortality table, loss triangles, etc. They look into historical experience. But sometimes for climate change, like we can see like record-breaking like heat waves coming every year. Like last year in Hong Kong, we got the record-breaking rainfall, which we didn't really expect. Like in a shopping mall, like the whole basement could be flooded. So there are a lot of like experience where we couldn't really see it historically. So that's why for students to equip themselves to engage more in climate risk or ESG, they really need to understand, like, read more news, understand the latest trend, latest technology in climate science. And they may look for, like go to our Catastrophe and Climate Research website, looking at our papers, talking more to the practitioners. I think they will be more prepared to this future. Yeah.
Yeah, so using the internet and talk to the right people, I think, right, that's important. Thank you, Timothy. Oh, Hong Chong, so like about if we want to go to insurance, general insurance, what advice you would give to the students?
I think firstly join the SOA seminars or events, get to know
Okay.
like practitioner. I think that's the easiest way for you to get the latest information, and from there and see what interests you, and probably read up or research more about that. And when it comes to general insurance, personally, I feel especially for fresh graduates, it's important to know that general insurance consists of many line of business. I think I gave earlier, I gave example, it's motor, home insurance, you have all different line of commercial business. So be curious, talk to different underwriters, try to understand the business better, and then when it comes to, say, reserving work or pricing work, that understanding of the insurance business will definitely help.
Yeah, Hong Chong, I think that's right. So what I heard from you is for life insurance, definitely there's a lot to learn, right? But for the general insurance, because you get a lot of different subject matters, right? So you need to learn about motors, you learn about like other like different kind of risks, etc. So I think that's not easy. So Timothy, back to you around so what do you think actuaries in general can do? Particularly not in the ESG field, but a general actuary can have the changes in the society to slow down the climate change is still a big topic in the world right now. So what do you think actuaries can do in generally? Yeah.
I think actuaries, as we are data experts, I think volunteering is one of the very useful way to contribute to society. Like we got our modeling skills, we got statistical skills. We can volunteer, no matter it's for SOA. Like SOA, of course, we got a lot of research programs. We got a lot of like data heavy papers and etc. But of course, contributing back to society, like talking to like different stakeholders and locally as well, this will be also very interesting. Or talking more about new types of climate products. Like if you just talk about like electric vehicles, like I think a lot of people complain about electric vehicles, the insurance being very expensive. But if we are really contributing a lot on this area, making sure that it's getting more affordable, or encouraging more people to drive EVs, maybe like one day people will think that it's more affordable. Just walk the talk and make sure you're aware of a lot of like different ESG topics, and talk to more people. Yeah.
Yeah, Timothy, I think that's a very good, but also very interesting. I like to follow your comment to Hong Chong around, like, will general insurer, I don't know whether it's a regulator, government, or who, like encourage more use of environmental friendly products like EV, blah, blah, etc. I think I'm not sure, but what do you think about of course, the relationship between ESG and then general insurance? So I'd like to fall back to Timothy questions to you on what do you think? Yeah.
I think regulators or most governments are trying to encourage all this EV, and also whether it's green building or such. And a lot of times, like regulators are asking insurance company to see, to explore whether there's any incentive can be given. Like for example, banks when they give out loans, they can give preferential rates if you are investing in, say, green related investment. Well, when it comes back to insurance, I think ultimately we need to look at the cost. What is the cost of insurance EV? So I think at the moment in most market it's something that most of the companies cannot crack. Repairing EVs are expensive. Actually, I should rephrase. There's very little to repair. Most of the time you have to replace. So it's very expensive compared to other conventional vehicles. So that's the challenge that I think everyone is trying to crack, but at the moment it's work in progress.
Yeah, thank you. So we need more actuaries to work together to crack this problem, right? Finally, we need to make people commercially sensitive to use more environmental friendly products, which again, so that's why we still have a lot to do. So I think the time is almost here. So thank you, Timothy and Cheng again, to sharing the future around ESG and general insurance. Thank you. So now we'll go to the, thank you. So now we go to another very important topic, of course, around the technology. Okay, so the next section is about the brain of actuarial knowledge and InsurTech. We have Terry. Okay, Terry will share this topic. Terry is currently the senior manager of insurance products of 1° Hong Kong, overseeing the individual life product portfolio, product pricing, reserving, and reinsurance of the company. He's also the associate of the Society of Actuaries and chartered enterprise risk analyst holder. So Terry, over to you to share a bit more about InsurTech.
Okay, thank you. I'd like to share my screen. Okay, can you see my screen?
Yes, perfect.
Okay, just a minute. Okay, yeah, I would like to talk about the brand of actuarial knowledge into InsurTech development. And I think it is a very, in recent year, people talk about InsurTech a lot and FinTech, InsurTech a lot. And I would like to talk about how this, how actuarial knowledge can blend into the development of InsurTech. So when we talk about InsurTech, we can break this term down into two items. The first is the insurance. That is the business that we actuaries are familiar with and have been working for many years. And the second phrase is about tech. For me, this is the tool to make things better. So by combining insurance and tech, we are able to leverage the technology to change the way insurance are delivered. So, and here we can see interrelating loops that the tech itself can change the way insurance and actuary work. And at the same time, the insurance itself, the business itself can help to shape the tech development direction. So in this process, the inputs from actuaries are essential. Otherwise, the tech development is not going into the right direction. And next, I'd like to show a traditional way of how insurance business deliver their business. How I make a simple model that how in traditional way how an insurance policy can be delivered to the end customer. And first, we start with the two blue boxes. That's the quotation system. That no matter it is a traditional paper format or on a fancy iPad point of sale platform, there's a system to quote the premium. And after the premium quotation, customer has to sign on the document, no matter on paper or on the fancy iPad point of sale system. They have to sign, and then the application will be submitted to the insurance company, to the underwriter, and there may be some back and forth conversation. The underwriter may have some questions, and there may be some correspondence or evidence need to provide to the underwriter to approve the case. And afterwards, the case is stored into the core system. And I used to work a lot with the AS400, and I take it as example. And then the policy is approved, and then the policy is issued after underwriting. And then 1 year after, the policy is subject to renewal, and then customer will receive a renewal notice. They make the payment, and then the policies. They make the payment, the system verify the payment, and then issue the renewal policy if necessary. So this is the traditional way. There are some significant delay in between, but customers see it as status quo and they accept it. And afterwards, when we talk about InsurTech, customer may have a different expectation to that. Some flows in their imagination or in their mind may be instant quotation. When they try to seek for their coverage, they get instant quote, and then that quote is based on their behavior, based on their profile, and that is a customized premium. My premium is different from yours. So, and then after I make up my mind and I decide to apply for the coverage, I get instant underwriting. I know the underwriting result instantly, and then the policy is issued instantly, happen at the same time. And after some time later, maybe 1 year later, when the policy is subject to renewal, that policy should be auto-renewed. That I do not need to travel to make the same process again in the next year. And as a customer, I would expect that the premium will be data-driven. That would be depends on the actual experience, my profile, my behavior. So if I have a good record and good behavior, the premium should be lower. That is dependent on my actual experience. And the decision made by an InsurTech company should be data-driven decisions. That's the fancy imagination towards InsurTech from customer. However, if we look at this flow from InsurTech and the previous slide, the traditional way, actually there's no major difference to the flow itself. The difference is how each step happens in between. The key highlights, the keywords here are instant, customized, automated, and data-driven. So, but the framework or the structure of this flow basically is the same as the traditional way. So to facilitate these changes, the input from actuaries becomes important. How actuaries' knowledge, especially in data analytics, in the expertise in insurance, will help to facilitate these changes. And in this slide, I will briefly walk through how actuaries help to enhance the InsurTech development. InsurTech is a topic, is the tool. It is subject to the development according to the needs of insurance. And in this subject, actuaries are the subject matter expert. So I'm not going to spell out one by one, but I would like to highlight some key points that actuaries can provide valuable inputs or opinions to this development. For example, the first item is instant quote. Actually, you may notice that this is not something new. It is something happening already. When you go to some insurance website, you are able to get instant quote. You are able to get instant quote and in a very efficient way. However, the difference with InsurTech is that the pace of premium review cycle becomes much frequent, much faster. And in traditional way, I recall when I was working in a traditional insurance company, when we do a simple reprice, it can take up from 4 months to 6 months to finish one premium reprice without change to the product feature. And to a more extreme case, to simply add a single field into the proposal, that will take 6 weeks to 2 months to add that. And if we are launching a brand new insurance product or to do a major product revamp, it can take up to 9 months to complete one cycle. So in traditional way, the premium charging may not be reflecting the actual experience of that risk. So, but under the InsurTech and environment, or under the era of InsurTech, actuaries can conduct a more precise risk-based premium setting, and it can be updated at a much faster pace than traditional way. And this is one of the key changes made possible by InsurTech. And with instant underwriting, we actuaries can develop a more granular risk segment, risk profile, and with differentiated underwriting rules. And one of the hot topics in recent 1 or 2 years is predictive underwriting. That the underwriter make use of the profile of the customer. It can be the traditional risk classification to combine with the lifestyle and also various data collect from multiple touch points to do a predictive underwriting, so that to make instant underwriting to complex case possible. And also with instant policy insurance, we are able to do some usage-based premium and insurance on demand. For example, I had a conversation with my colleague in last 2 weeks that insurance on demand may be a future of with the help of InsurTech. For example, car sharing scheme. One person may use the car for certain days, and then the next person use for certain days within a month. So insurance on demand may be one of the potential markets for this kind of new behavior. And then for the auto renewal, and insurance company nowadays can build some predictive model to predict customers' behavior regarding their renewal, whether they tend to renew the policy or not. And actuaries input can help to enhance the CRM initiative for customer segmentation. And actually, I know that some insurers or some InsurTech companies has been building such predictive model to predict the renewal behavior, cancellation likeness, or even the claims predictions. And actually, our company is also working on the same direction to build such model. And in such model building, actuaries input is essential. And with all this InsurTech development and technology advancement, data-driven decisions can be made to be more customized, to offer more customized premium, more customer advice, or more granular risk classification. And another point I wish to highlight in here is that in the development of InsurTech, what valuable input from actuaries can be made to the right direction. I recall that in last month that I have a colleague from tech development very excitedly come to me and telling me that, Terry, now our system is able to support charging premium to, according to each customer's behavior and each customer's profile. And it sounds that it is a very sexy idea and really customer centric, that each customer, in theory, they can have their own premium and according to their own experience and risk assessment. And however, as actuary, we may have a different angle. So in this slide, in this graph, there are two extremes here. To the left, it is the insurance company offer customized offer. Customer pay for their own risk. So in theory, each customer can have their own premium setting according to their actual experience and the risk estimation from the insurer. To the right is another extreme. There is one price strategy. All customers pay for the same premium. Of course, there are pros and cons to each extreme. To the left, it is very customized, of course, very customized premium setting. But in the angle of actuaries, there's a problem that the risk may become too granular and the experience may become too volatile to do meaningful assessment, to do meaningful conclusion, or to do meaningful risk experience study. And to the right, there's no customized offer, and there are cross-subsidizing between risks occurred. Some customers are overcharged, and some customers are undercharged. So as actuaries, our value is to obtain a balance in between. We should advise to the tech people that a balance there should be a balance between granularity between customization and the volume of each risk pool, so that each risk pool will have sufficient volume to do meaningful analysis and experience study. And that's the value of actuaries. If we do not provide such opinion, some people may think that customization is good and making each risk pool too granular and the risk become too volatile. And last, I would like to introduce some non-traditional functions in InsurTech, and that would require actuarial profession. In summary, all these non-traditional functions are leveraging the technical skill of actuaries to make correct or effective business decision. The first is about portfolio management. So like in an insurance company, there are a lot of products offered to their customer. But with a proper portfolio management, the actuaries shall be able to identify which products are generating a better value to the company and how to optimize underwriting profit among all these products. And the second is about CRM analysis. Unlike traditional insurance company, they may rely on agents or the banks to maintain relationships with customers. However, under InsurTech environment, the insurance company tend to do direct selling through their portal, through their website. They do not use intermediaries. So to maintain a customer relationship, CRM initiative or CRM analysis is essential. So actuaries can help to identify which customer have a higher stickiness to the company and who do not. And for those who tend to leave the company, the CRM department can do some early dating and initiative to keep customer with the company. And we are also able to predict customers' behavior through a predictive model for claims behavior, renewal behavior, cancellation likeliness, and etc. And I've been involving in such model building in the past month. So it is something new and something attractive to the CRM in terms of CRM. And the third is about product mix analysis. So we are able to, from the data, we should be able to identify the strategic positioning of each product. And we, based on the analytical result, based on data, we can help to make decisions to abandon non-performing products that are making loss, that is not contributing values to the company. And we are able to facilitate the data-driven decisions. And last but not the least, this is a very important point, that actuaries can help system development. So in Hong Kong, including us, there are a lot of InsurTech companies that develop their own core system. So they run their own insurance business in one side, and on the other hand, they build their own system. So this is a mutual development relationship that from the experience they gain from the insurance business, they can enhance their system's capability to enhance the function and to make it more relevant, more handy for insurance companies, so that they can sell the system to other insurance companies. And at the same time, the system development can benefit the insurance business they run. And then this is like to create a positive cycle, or to create a mutual development relationship between the two business lines. And through this process, actuaries' input is very essential, very important to drive the system development to the right direction. And of course, there are many others non-traditional roles that requires the profession from actuaries. But in terms of InsurTech, these are the most important points that we may focus. And yeah, that's all from my introduction. And thank you very much for your time. And any questions?
Thank you, Terry. I think there's a great presentation. It's a few minutes behind the agenda, so I need to catch it up. So I think definitely people can ask questions, and I think we can answer them together with after Weisman presentation. So Terry just put on hold for a while. First, thank you
Sure.
again, Terry.
Thank you.
So the next section is for we have the speaker Raymond Lai. Raymond will share the topic on actual skills in risk management across traditional and emerging industry. Raymond is FSA and has over 30 years of actuarial, financial, and risk management experience in life insurance, general insurance, and family takaful insurance, medical insurance, and InsurTech startup, basically everything. He is currently a member of SOA Greater Asia Committee for Malaysia. Raymond was previously held appointed actuary, chief actuary, and CRO roles in Malaysia and Vietnam, and is currently heading risk management practice in Automate, as well as holding appointed actuarial roles for international global insurers in both Bahrain and Labuan and InsurTech startup company in Malaysia. Raymond was a past president of the Actual Societies of Malaysia. Without further ado, Raymond, pass you on you to share with us on the topic. Thank you, Raymond.
Yeah, thank you for the introductions. Let me share my screen first. Okay. So can you see my screen?
Not yet.
Not yet. Okay, let me check. Not yet. Share screen first. Okay, share.
Oh, it's coming. It's coming now. Yeah, Raymond. Yes, we can. I can see your screen, but not yet a whole screen yet. Yeah, not a full screen yet. Yeah, it's good now. Thank you, Raymond.
All right. Thanks. Okay, first I'd like to thank the SOA for inviting me to share my experience in the professions. So actually, I was working for the life insurance as appointed actuaries for more than 10 years. Okay, especially in the life insurance sectors as appointed actuary. Then later on, I moved on to other traditional, non-traditional sectors. For example, when I see the opportunity in the risk management area, so I moved into that. And after that, I will see that non-traditional are more interesting, so where I can apply the actual skills, Then I moved into, while doing the risk management, I also involved in the general insurance, takaful insurance, as well as InsurTech, artificial intelligence, and the data analytics too. So that's why I'm going to share with you, how do we apply the actual skills specialized in the risk management area. Of course, this presentation I'll just intended for educational purposes. Okay, in the this presentation, I will just introduce what lessons can you learn from failures and of success of risk management itself, because there are a lot of events happening, right? In the past as well, quite recently. So what can we actually learn from it, from the perspective of risk management? And after that, I looked at the global perspective of the on risk management itself. And then what are the emerging developments and trends, especially on in the world itself, right? That actually related back to risk management itself. And because of all those three areas that I presented, then you can see that there actually is a high demand and opportunities in the risk management. And what are the skills and competencies required, for actuaries to be involved in the risk management side. Just now in the past presentations, you find that actuaries are always involved in risk management because actuaries are in risk. So of course they are specialized as a product actuary, I think, and they're specialized in insurance industry. That's why they still have to do the ERM. They still have to do a lot of capital, requirements, for the specialized in the industry, the insurance industry itself. But what I'm talking about here is not only on the insurance industry, we are talking about expanding actual skill into non-traditional, out of the traditional fields, out of the insurance field, and they can go into any other fields that really requires on the risk management itself. So that's what I'm going to present, share my knowledge on that. Now, as you know that these are first lessons about the failure of the risk measures. As you remember that the AIG financial crisis in 2008. So these are started from the Lehman Brothers collapse. Okay, so basically this Lehman Brothers was one of the global financial services firms. It collapses in 2008 due to the collapse of the housing market itself. So during that time here, it's like so this leads to banking crisis as well as the economic crisis, debt crisis too. So these are actually very good lessons to learn from it. I think during that time here, right, in 2008, I think the financial services was deregulated. So deregulation. So what happened here is a lot of lending firms like Lehman Brothers offers a lot of lendings to all those borrowers, right? Home loans, especially home loans, to the borrowers with actually very low credit histories. So that happens here. That causes the increase of the housing market itself. So of course, all these the housing loans was also packaged, bundles together, right, into what we call derivatives, collateral derivatives called the MBS, the mortgage-backed securities. So, and then the credit firms, because they don't understand also about what is this mortgage-based security, they also treat that as a low-risk assets. So that causes a lot of banks actually in the increase, leverage, take a lot of leverage here to invest in this MBS has a low-risk asset itself. So when the crisis comes, the whole housing markets collapses, and then it causes that the all this crisis happens. And then of course AIG, right, was also issue a lot of credit default swaps, right, and then it depends on the credit ratings of the credit firms, and that has low risk assets, and then they are actually overexposed with these credit default swaps, and then when the subprime crisis happens, they do not have enough liquidity, right, to pay the claims. Too much claims are involved, because once it collapses, there's a systematic risk, and then causes the whole financial and the markets to collapse itself. So during that time, because AIG was too big to collapse. So they need to get the government bailout. So a lot of US to take over AIG. So basically, there's a bailout for 85 billions. So I think the lesson learned here is like, what's the reason for all those collapse? During the incident is due to risk management failures. So a lot of these type of products, right, is so complex, and then people don't really understand, what this product is all about, and then they did not do a comprehensive risk assessment of that product itself. So during the crisis itself, there's a systematic crisis. It also causes liquidity issues where cash flows are limited, and then most banks do not want to lend. If you can still remember that during the crisis itself, all banks are stop lending to people because they worry that there will be a lot of non-performing loans if they lend to the firms, all those things. So of course now, because of deregulation, so now the regulator also understand that we really need to have a strong regulatory oversight of the financial services sectors, and they overlook that, so that the company do not really invest in risky investments. Right? So this is one of the things that you can learn from on the AIG financial crisis. So the next one is quite clear. you can remember that the global COVID-19 pandemic in 2020 itself. So the point is when the next calamity will happens, it's a matter of if, but not when. But are we prepared to respond better and faster in the next pandemic itself? So I think from that we can learn that it is very important to prepare, right? Especially the organization to prepare and plan, right, for the next pandemic. So in that for example, you need to have like what are the protocol, what's how do you have accept the resources allocations, and then what's the communications like when there's a pandemic itself. So in their business plan itself, of course, you have to incorporate the scenarios, like what if there's a pandemic, so of course when you talk about multinational firms, depending, or maybe company depending on supply from the other regions, other countries itself, then what about the supply chain? Do you have, what if you don't get the supply from raw material from one region? So do you have any alternative for it? So, and then of course of that also, the company to have a comprehensive BCP, a business continuity planning here. So and also it must also have the remote work capability. If this, in the pandemic itself, it could be a lockdown, shutdown. So can the people, cannot go to work in the office itself? Do they have they can work from home itself? So a lot, I think now previously they have a lot work from homes, but that now people are start moving to 50%, work from home, and then 50% back to the office itself. Then eventually some of course they 100% will go back to work itself. So I think people need to be aware, make sure to have the that type of facilities in place, so that, or infrastructure in place, so that they can work in a remote home. Technologies and digital transformations, I think is very, very important. So I think after the global COVID-19 pandemic itself, I think most companies understand that they could shut down. They cannot go to a physical office there. So they must have a digital infrastructure in place, like so that they can work from anywhere itself. So the side technology and digital transformation is important. And then how are they, use AI or automation? Are the processes all automated? So all these things they can learn from this type of pandemic itself. And how about health and safety protocols, like all those social distancing, and then what about these sanitizations and all the protocols need to be in place too, like and crisis management. Crisis can happen anytime. I think recently there is like a monkeypox, you say it may be the next pandemic, but you don't know what happened in the future itself. So in every organization, you should have a crisis management team, and then where they can actually provide clear communications on what to do, when the next pandemic is coming. Of course, the important here is there's a pandemic, like of course the effect the financial of the company itself. Liquidity will affect, then there will be no business, no sales, no profits, So whether the company can sustain themselves, and then do they have other revenue streams or not, apart from their original stream in case of a pandemic. You see, during the pandemic itself, right, you find that a lot of companies, right, actually closed down, right, and they collapse because they mismanage their business plan itself. There is no business, they do not have enough cash flow, and then you have liquidity issues, and then the cost is increasing. They have to cut they have to terminate all the employees itself, retrenchments, and then at the end of the day, they collapse too. So of course, pandemic also impact, like there's laws, you have to follow regulatory requirements, you have to comply with it also. So I mean the company itself, of course, have to adapt to all those changes in the operations. Right. So I think pandemic always happens, whether it's a small or big one. When a big one comes, I think even bigger than the COVID-19, right? Worse than that, So are we really prepared not to respond, better and faster in the future? Okay, I think this is also another one lesson that you can learn here. Some of the lesson of past wars teach us that effective risk management is not about preparing for the last conflict, but also for the next one in all its unpredictabilities. You see, like this recent one, the Ukraine's invasions here in 2022. I know that this is going to be a very long time of a war. You know, until now, it's still not ending yet. So that's why it's very important, especially organizations who have business in the in other countries, in other regions, especially in Russia's, depending on the raw material in Russia's and Ukraine itself, right? So it's actually very important to assess risk assessments on the geopolitical risk itself. I think constant monitoring, geopolitical development, I think all these are very important. And then of course, you have to incorporate all those scenario planning, in your business plan. Also, what happened here, when the war happens, then you stop the raw materials. Do you have any supplies from for your business itself? So are there any, you have to manage your inventory also. And then of course transportation, especially transportation also is different type of routes of transportation is also critical. And then of course like companies that depends on energy like oil, so when there's a war in Russia and Ukraine itself, of course you don't get the energy from these type of countries. So then you have to think of how do you diversify your energy resources, and do you have strategic reserve from somewhere else, some other countries, as preparations. Of course, risk of cyber attacks, also the key risk. Okay, in this type of war itself, there are a lot of phishing, social engineering, and then we really need that. When I say really need to have this cyber type of defense, and then we have those awareness and training program on cyber security. The cyber security risk is actually one of the very, very critical risks also. And of course, definitely impact the financial of the company itself. So the company should have a business plan, go through all those stress testings, with different type of scenarios, and then how the company going to manage their cash flow and liquidity too. Of course, there will be sanctions going on, and also apply, and then of course the company have to comply with all the sanctions also. So especially if you are dealing with Russia and Ukraine itself, and they say, okay, now you cannot hear a sanction, you cannot work with them, So then what is your alternative? You have to adjust your operations, So these are the things that we can learn from it. I think the recent one here is very important here. It's like the recent attempted assassinations, like former US President Donald Trump himself. So I think actually what happens, there are so many top assassinations in the past also. So why is that these type of incidents can happen even quite recently? So during the first gatherings itself. So I think when I analyze all those things, I found that they actually the assessment, the proper risk assessment was inadequate itself. So actually it underestimates the level of threats, and then they have a poor intelligence gathering and analysis itself. So that is one of the things here that causes that. And communications failure also, because there are poor coordination between various securities, all those secret agencies and the team itself. So I think during that time, right, half an hour before the shooting itself, people already tell that, oh, there's a sniper, up the roof, but then nobody actually take actions. I think the delay in the taking actions, So even the secret agencies went up to the roof itself and looked at it. They already seen the shooters, I think half an hour before that, but no action had been taken there. So don't know what to do also sometimes. So and then of course the public access, So when you say, these are important gatherings happening here, then they have to make sure that the public access properly manage itself. So because mismanagement here also creates vulnerabilities and opportunities for attackers to attack. So these are the one of the things that we can learn from it. and also a failure in coordination, especially on the local law enforcement as well, and together with all those federal law. So they have like inconsistent protocols, and then they have actually a very poor integrations. So all those things are happening, you know. So luckily it was happening the first gathering itself. So at least they know what to do in the future ones. So it's just, you look at the shooting, is really very scary itself. They just move a little bit by few seconds only, otherwise it will be dead already. Effective risk management in context of potential assassination involves not only protecting the individual, but also anticipating and mitigating the threats before they actually materialize. Okay, so those are the things that failures, you know, on risk management itself. I think we also can learn from the AIG, you know, post-crisis recovery. Actually, AIG, after the getting the bailout, right, they implemented the ERM programs, and then they enhance the risk governance, and then just integrate the risk oversight in all the business unit itself. So there's a risk culture improved, and then they emphasize on accountability and the transparency, thus promoting risk, more awareness on the risk. They have the risk awareness culture itself. And then of course they also do more advanced risk analytics, and then they will do more on stress testing capabilities, and then more on the risk analytics here, so that you can really understand the risk they are taking, and then what are the mitigations plans, you know, to mitigate the risk itself. So once they have done they implemented these ERM programs, right, their financial stabilities are more stable itself, and will be able to pay the government bailout funds, and then now back to profitability itself. So I think so with this type of implementation of ERM program is quite successful. So they can navigate through all the subsequent economics downturns and have greater financial stabilities in the future. They can actually weather through the next financial crisis also. So these are the things that we can learn from it. Okay, from the global perspective itself, of course, you know that the importance of risk management itself. So you look at from the framework itself, there are some global risk management regulations. There's a regulatory frameworks like Basel Accords for the bank itself, Solvency II, and then the Dodd-Frank's Acts, especially to monitor the financial, so that there will be no next financial crisis. And then there are some regulatory bodies like Financial Stability Board, International Organization of Securities Commissioners, and International Association of Insurance Supervisors. So these are regular bodies to monitor the risk in different type of areas itself. There are also emerging regulations. Okay, new one. For example, you're talking about ESG regulations. Okay, and the climate change, you know, and what is a cyber security regulation. So these are the emerging regulations that actually company needs to comply to. So that from here you look at that there are so many type of bodies are monitoring on the risk management side, and then the company have to actually comply with all these regulations. There, when you do a cross-border risk, so there are many type of risks that are involved, like geopolitical risk, financial risk, legal, regulatory, operational risk, strategic. So all, there are many type of risks is in the world that faced by the company itself. So you look at from global perspective, like you know, if you are like multinational companies, right, you're always subject to all these risks, and then you have to actually comply with the different type of regulation from different countries too. Okay, so on the emerging developments and trends itself, and you know that the technology and AIs are, okay, especially AI, machine learnings are actually very, very important, and you can actually make use of leverage on technology here to do risk management also, and there are a lot of data analytics, okay, and how do you make use of the all the data that you have, all the data sets will give you insights into the risk factors that we can actually use to assess our risk, okay, and so they can mitigate the risk factor. blockchain is so key important things. Because blockchain is talk about transparency, security, and then it will be more efficiency, so that you can use to manage the risk too. I think cyber securities and digital risk, I think is very important. There are a lot of cyber threats are increasing day to day, and of course, we as organization, we also have to comply with all this cyber security regulation as well. And regulations, compliance always changing. Okay, when there are new technology changing, the regulation also changes. So the regulation is also evolving, and then of course, as a company itself, you need to comply with the regulations from not only from your own country itself. Sometimes if you do business in other countries itself, you still have to comply with the regulation of other countries. So like climate change just now, I think there's a presentation about this climate change, quite a detailed one. And so I think, it's very important. So these are the risks that is very important, environmental risks. And of course, at the end of the day, all are involved. Talking about the sustainability of the company itself, right? Whether you can sustain your business itself, and then how does the climate and environmental impact your business itself. So these are the focus and trends that is very important for the company itself. Of course, innovation and disruptions are always there. Okay, with the technology itself, they always day to day. You will see new innovations, new disruptions here. And are you ready? Are you still are you adopting innovations, disruption? Otherwise, you will be disrupted, and then you don't have the business itself. And the landscape of risk is also changing, worldwide itself. So there are too many types of risks here itself. So the company also have to be ready for the changes in the risk environment. Our pandemic, just I talked about pandemic and health risks. So these are the key ones. And you need to prepare for this crisis. Scenario planning, I think most companies are talking about scenario planning and financial stress testing. So I think all in all, so I think the culture of companies, so I think all these are very important too. Okay, so these are the trends that's happening in the world now. So I think from the this World Economic Forum itself, so I think every year they have these type of studies, a survey done, and then so this is the year Global Risk Report 2024 itself. So from the top 7 global risks is extreme weather. I think this is linked back to the climate change. And then AI generated misinformations and disinformations. So all these are due to AI and technologies. So I think all these are very important. Societal political polarizations, cost of living crisis, cyber attacks, economic downturn, possible because now the interest is very high, then high inflation rates, and then the impact the business too. So and then disrupted supply chains for critical goods and resources. So currently these are the top 7 global risks. Okay, so on because of all those global perspective, and then the developments that I think there's what I look at it is a demands opportunity in the risk management itself. So you look at the world itself, like they are actually all interconnected. So I think definitely it involves cross-border risks, and then we also have the supply chains vulnerabilities too. And on the regulations environment side, then of course the increased regulation in financial and insurance also. So I think a lot of regulation involves scrutinize on the comprehensive risk management frameworks. So a lot of things are regulatory, especially on the regulations on the risk management itself. So technology advancements, okay, it's not talking about the AI and the technology itself. So this is imposed causes the cyber attacks, cyber threats, all these cybersecurity risks. And then of course most companies are moving into digitalization, they are transforming. So when digital transformations, they do their business on the digital platforms. Of course, this also pose a lot of the risk too. Natural disaster, climate change, of course, this one will cause environmental risk, sustainability goals also affected. Some of the most of the operations in the company itself, right? They're quite complex. Okay, so that's why you need to have complex operations here. Then it needs required business BCP, business continuity planning also. So financial risks, all the legals, all those pandemic strategies. So all these are like you look at so much risk there in the world itself. So of course you know that the every organization also was subject to all those risks itself. So that's why there's a high demand of risk managers itself. All right. Okay. Now, how does the actuary helps in in this risk management itself? First of all, is for actuaries they has expertise in the quantitative analysis itself. I think in the traditional risk management itself, they do more on the qualitative. They tick the box, whether you meet all those criteria or not. So I think as actuary, you can use the data, right, to make decisions. That's why you call the data-driven decision making here. And then you can apply the predictive modeling, right? Predictive modeling, okay, predictive modelings, and then for this one. So
hey, Raymond.
Yeah.
Yeah. So sorry that interrupt a bit. I think that the all great sharing, but can we just we just in view of time, you can wrap it up. That would be great. Thank you.
This is the last one. Don't worry. Okay. Of course, predictive modeling, understanding of financial theories are important. So I think these are the skills that is required, because I think actuaries like they deal a lot of regulations and complying. So I think they are quite suitable for all this stuff, risk management. And then of course the actuary also have strategic thinkings, and then they can solve problems. They have a risk assessment, all this collaboration, technology advancements. So okay, these are the skills that I think they require as a risk manager itself. Okay, final thoughts here is like amidst this VUCA, volatile, uncertain, complex and ambiguous global landscape, the demand for risk management has never been higher. And actuaries with this unparalleled expertise in quantitative analysis, financial theory, and predictive modeling are uniquely positioned to navigate these challenges and safeguard organizations' resilience. Okay, I think that's the end of the presentation. Yeah. All right.
Okay, thank you, Raymond. So thank you very much for your sharing. I think that. Hello. Can you hear me, right?
Yeah.
Yeah, sorry. Also, I got some problem with my connection here, so I changed a bit of background. So again, thank you, Raymond, for your sharing. In view of time, I think we may just skip a little bit the Q&A sections if everyone is okay. So again, I think thank you, Raymond and Terry, for the sharing. So we will go to the last sections with Anne and Justin about sharing the non-traditional actuarial careers. Anne and Justin will share the topic on non-traditional actuarial career. Anne is the program actuary from Cathay Pacific Airways Limited, so the airline, like managing Asian Miles. I'm also one of the Asian Miles membership program members to become the second most desirable currency in Hong Kong, right? Before entering the whole new world, Anne was a reinsurance group pricing actuary specializing in cancer risk and catastrophic diseases. She was also involved in the product development of life cycle type health insurance, and one presents the relevant research findings in Japanese. Anne is a fellow from the Society of Actuaries. She also actively promotes gender equality and cultural diversity in Cathay Pacific. Justin is another speaker. Is currently the head of product lending and insurance at Grab. The Uber competitor. And I think Justin can share a bit about Grab. He is passionate about building products from scratch and exploring spaces which are risk for disruptions. He joined
Grab Financial Group to be part of its missions to mobilize financial services in Southeast Asia, making product more simple, transparent, and accessible to everyday customer. In his current roles, he leads the product teams for lending and insurance. Okay, without further ado, I think I will skip a bit the lengthy introduction and we go directly to Anne and Justin. So welcome Anne and Justin on stage. So
thank you, Billy.
Thank you. Sorry for that. I got some problem with my Wi-Fi here, so I'm a little bit, yeah. So hi Anne and Justin. Yeah. So maybe Anne, can you just describe a little bit more yourself and describe your current roles? Of course, I think the more interesting part is you're an actuary, but it seems you work in a very untraditional field. So Anne, over to you first. Okay.
Yeah, sure. So let me talk more about my role. The program in the job title of Program Actuary is referring to our frequent flyer program, Cathay. And my role is mainly to manage our loyalty point, Asia Miles. And if you travel, no matter it's for leisure or for business, then our brand won't definitely be a stranger to you. And you can earn miles by taking our flights or use our co-branded credit cards. And of course, the most attractive award to redeem with Asia Miles is our free flight tickets offered by Cathay and also our One World airline partners. And we also offer retail and hotel redemption options through our Cathay Shop and Cathay Holidays platforms. So my job as the actuary here is to look after the miles balance from an aggregate perspective, to manage the accrual, the redemption, the expiry, so that overall the program is growing sustainably. And the big topics for me are liability, which essentially is reserving for the future redemption cost. And also breakage, the miles earned, which are not redeemed, but expired. It's a source of profit for us, but we don't want it. We prefer the revenue when members keep engaging with us. And other topics I explore are, of course, pricing, the miles conversion rate you are seeing across our products with miles plus cash payment, and also customer lifetime value, the projection of the expected future profit coming from our members. So after a mile is earned and accrued to member miles balance, the most important next question for us is whether that miles will redeem or whether that miles will expire. And as an actuary, we immediately know that the sum of the above two probabilities is 1, right? So putting forward an assumption for this can be considered as the key R&R for an actuary working in a loyalty program like myself. And you can imagine majority of the changes happening to the program or to the airline will have an impact on this assumption, and also on the future development of the miles balance, and also on the liability reserved for the future miles redemption cost. So some examples we look at would be, for example, the miles expiry terms and conditions, the flight redemption award chart, the membership benefits, whether it's attractive or not, or even the pandemic, of course. So therefore, we have a set of KPIs to assist us in managing the Cathay program and also Asia Miles. And we quantify and influence the value of mile as well. And it's governed by our version of IFRS. It's not 17. In our world, is IFRS 15. It provides a standard on deferred revenue, on timing of revenue recognition, on selling price of mile, etc. The topics can get more advanced, like modeling member transaction behavior to project customer lifetime value, which is a very effective tool to drive business decisions for us. And pricing of mile is another very dynamic topic. We established some frameworks, guidelines internally, and leveraging my prior experience as a reinsurance pricing actuary. So I can continue forever, but let me pause here for now.
Thank you. And so maybe we go a little bit to Justin about Grab. You can share a little bit about Grab and then about your role. Thank you, Justin.
Yeah, sure. So for those that aren't aware, Grab is the super app of Southeast Asia. So I think Billy just mentioned that it's a competitor to Uber. We actually don't compete in the same markets, but you can think of our services as transport, deliveries, and a fintech arm. So I currently work as a head of product in the fintech arm, and my team actually develops brand new products, mostly digital, for lending and insurance. So if you think about the various users of Grab, we have the end users who are actually taking the transport services. You have the drivers and you have the merchants as well. So merchants in this case are the little shops that provide the food that get delivered. So my team not only does insurance for Grab end users, which is mostly focused on embedded insurance, finding ways in which we can package insurance with Grab services. But it's also about how can we develop new products to help the underserved segments, like the drivers and merchants of Southeast Asia. So I have a team of 7 product managers. We focus very much on building new micro insurance products to make sure that insurance products are easier to understand. They're more accessible to these users that are not so financially savvy, and they typically don't have a lot of insurance products. And if you think about the penetration rate in Southeast Asia, outside of Singapore, it's still very, very low. So it's part of our broader mission to basically increase that accessibility of insurance and also credit products for these populations.
Yeah, thank you. So maybe I go a bit further. Of course it's a very different or non-traditional. So about yourself, right? So what motivates you to explore to this non-traditional actually? Why you just don't go to a life insurance company? Can you share a little bit about your career?
Yeah, sure. I can start. So for me, I started off at Sun Life. I was in a traditional actuarial student program, and I was in my 3rd year outside of university, and I was rotated to reserving. And I was not a big fan of the job. There was a lot of number crunching involved. And I think I realized that I wanted to do something that had higher impact on our customers. And wanted to be a part of the actual product development. I realized that, at least from an insurance perspective, when we develop products, we always take an underwriting lens. We don't really think about what is our users' needs. And that's what actually propelled me to make the switch. I realized that I had a much more entrepreneurial streak. I wanted to build products from scratch, and I wanted to really make an impact on customers. And that's what ultimately led me to make the shift outside of actuarial. It was actually quite a long journey because I did not become a product manager right away. I went through many transitions, but I eventually landed in my current role as a head of product. When I was with Liberty, I was also the head of innovation as well. So that's the high level as to how I ended up where I am today.
Wow, thank you, Justin. I think definitely this is more exciting career, which I think everyone listening, I think you just also feel the excitement. So I go back to Anne, right? And so what inspired you to try something not just not life insurance or very traditional field to go to new inspire you? Yeah.
I actually strongly resonate with Justin as well. So
Yeah.
I actually started exploring non-traditional actuarial roles quite early stage of my career. And this current one is not the first non-traditional actuarial role I land on. And it's just come down to my principle that when it comes to job, I don't want to settle for less, because it's something that I dedicate hours of my day, like decades of my life on. I need to seek some meaning in it. And that's why I would say I was really fortunate to have come across interesting job that I love and feel passionate about. And particularly for this current role, like it was titled Program Actuary, and with a company name of Cathay Pacific Airways Limited. And I was like, why would an airline be hiring actuaries? I was very curious, and by knowing more and more about this niche field of application for actuaries, and also by researching how math works behind frequent flyer programs and behind loyalty programs. And by understanding more about like the expectations of this role from interviews, etc., I knew exactly this is the adventure I want. So I decided to go for it.
Right. And thank you, Anne and Justin. If you don't mind, I'd like to. I know I got a list of questions, but I'd like to add a little bit more, if you don't mind, a little bit. But I think it's quite lecture. So Anne, when I heard about you about getting the cafe position, can you share a little bit on when you do the interview of that job on what are you what do you think you what have you shared with your like the supervisor and manager, and then finally how you get the job? Can you share a little bit of the interview process? I think that would be very interesting to everyone here. Yeah.
I think the most important thing is really to prepare. Like once I knew that this job exists, then I start to look for information of loyalty programs, frequent flyer programs, and as an actuary, especially what's our role in it. And of course, I then come to know about how's the mileage sales works for this loyalty program business. I then come to know about how's the distribution between the airlines contribution in the loyalty business, and how's the third-party partners role play in this loyalty business. So I also come to know about, of course, the accounting standard that works within this industry as well. So knowing our role that can play in a part of breakage of miles expiry, that can leverage on our expertise to understand and interpret data and how to project into the future in all those forecast exercise, and how to prepare for the reserving of the future miles redemption cost when members are redeeming with flight tickets and with other options, etc. So by understanding this entire picture is how you can build up that communication and connection with your future supervisor, and they feel confident that you are the actuary that we are looking for.
Wow, thank you. And I think that's should be a very exciting moment. Of course, I heard you that you need to prepare a lot, right, before you can get the job. Again, audience, if you got any questions for Anne and Justin, you can tap in the Q&A box or the chat box. So Justin, if you don't mind, you can share a little bit your interview experience when you go into the job for Grab. Yeah.
Yeah, sure. So I can talk about both Liberty and Grab, because those are the 2 points where I transition, right? So for context, when I jumped out of actuarial from Sun Life to Liberty Mutual, I went from actuarial to marketing and analytics. So that was the first jump that I made. And then obviously for Grab, I became a head of product for insurance. So, what's funny is that both times that I applied for a job for the 2 new companies, I got rejected the first time. I actually didn't get the job. But the thing was that I did leave a very good impression. I think the reality is that when you're trying to transition outside of your function, or if you're trying to transition outside of your industry, like I was doing from insurance to tech, there's always like a question mark of like, oh, can you make the jump? And I think the key is being able to communicate how your experiences in your prior role are relevant to the role that you're applying to for the new company. And really focusing on the impact that you made. I tend to see this happen a lot, right? When people write their resumes, when people talk about their work, they really focus more on the sort of day-to-day responsibilities and what it is that they're doing, rather than focusing on the why and the impact of their work. Because fundamentally, that's what you need to do in these types of roles. They want you to drive results, right? It's not just cranking out a spreadsheet at the end of the day. You need to be able to improve take-up numbers. You have to be able to showcase that you have the insight to be able to derive results that can change the direction of the business or change the strategy of the organization. So really emphasizing the why and the impact is the first thing. So I guess following up to my old point around getting rejected the first time for both companies, the key thing that I did was I made sure that I left it off at a graceful point, right? And said, hey, look, enjoyed the interview process. Let's stay in touch, really interested in the organization and any sort of future roles. Let's keep in touch. And actually for the Grab role, I did have follow-up lunches with the manager at the time. because it took about 18 months later before they reached back out for the other role. But the fact that I kept in communication with him, that I was sharing insights with him over lunch about where the industry was headed, and my experiences as a head of innovation at the time for Liberty kind of showed that I had the capabilities, that I had the experience, and eventually that was actually what got me over and made them comfortable calling me back for a role. So I'll leave it there.
Thank you, Justin. I think that's great. I received one question from the audience, but I wait for a few more before I go to you. I want to, Justin, maybe I like to get a bit more from your current, like a bit non-traditional actual role. If you want to name only one, the largest challenge, like what will you tell us about? What is the largest, like, a challenge in your daily life? Yeah.
Learning to say no is the biggest challenge, right? So the organizations that I've worked in, they're very matrix. There's lots of stakeholders. Everyone has lots of ideas about, what to build, like what new insurance products to build, what are the new features and capabilities. So the difficult job of a product manager is to be able to take the hundreds of ideas that you're going to get on a day-to-day basis and be able to prioritize and understand what's noise and what's actually going to make a difference for our users and actually going to make an impact on the business. And that was something that I struggled a lot with, especially when I first joined Grab, because there's so many ideas and there's lots of smart people in the company that want us to build things, but I've got a limited number of resources, and I basically hold the key to making sure that we get the most out of the engineers and the designers and the product managers within my team, so that we really focus on the things that make a difference. And you have to know how to say no. You have to know what to say no to, firstly, and then you have to know how to say no.
How to say no, yeah.
So I think that's the biggest challenge.
Yeah. I think that's not easy. I think echo a bit. I think it's being an actuary. Sometimes I think we are trying to solve all the very complicated problems. So my first instinct is always to, okay, we find a way to solve it, right? We don't say no that often. I think that's true. So Anne, may I go to you? What do you think your biggest challenge in this, like, a non-traditional actuarial roles? Yeah.
I think it's time management and prioritization. It's quite similar, but I think moving to non-traditional actuarial role, it's exciting. You get to apply the range of actuarial skills and knowledge in an entirely new environment. And there must be so much you want to achieve together with your team. And hence, it's so soon that your pipeline list will get longer, and gradually you start to lose focus from what should be the top priority, because importance will get mixed up with deadlines. So I constantly remind myself to manage my time better across the different topics that I look after. And also, I think it's important to spare time for take a step back, to think, to brainstorm, and to better prioritize the different pipelines. So leaving some time for thinking is actually very important.
Thank you, Anne. Actually, I would like to, the questions I received from the audience is a technical question, but I think it's interesting, so you can spend a minute to answer that. The question is, when you estimate your customer lifetime value, what are the components, is your considerations, and what are the challenges in this process? So it's a little bit technical, but Anne, can you just go for it?
Of course. So most important aspect is definitely the past historical experience that we have across our customers. So the earn pattern, the burn pattern, the location, the tiers of those members, the different earn year, how does that behavior change? And when you talk about customer lifetime value, right, then of course life stages across people changes. So across time, of course, our program will have changes as well. And because we work in a line, like what's the plan for the industry, the market outlook, the trend for the industry in the next 10 years, 20 years. Like these are all the important components that we build up into this customer lifetime value modeling. So it actually involves very close collaboration with our data scientists as well. So you can imagine some of the platforms that we use will be beyond what we normally use for our actuarial modeling. So a lot of time it involves machine learning techniques. It would involve big data platform, etc.
Right. Thank you. Thank you. And maybe I got two more questions, and I think we will end this sections. So Anne, maybe you first is what do your personal view about the future trend of actuarial professions? Do you see it's still a growing, very promising, or what changes you will see? Yeah.
I think we would all agree that more and more companies that seem unrelated to insurance are starting to hire actuaries. Like Justin worked for Grab, I work for Cathay. I know, for example, Uber, Google, Amazon, these companies have actuaries as well. The list might be longer, just I don't know yet. But like in a world full of uncertainty and risk, I feel like more and more companies will value this ability of understanding how to interpret data and use data to forecast into the future to help companies to navigate the ambiguity in the business world. And hence, together with some of the other skills and knowledge that we have built up along our actuarial career, such as the soft skill side as well, the communication, stakeholder management, interpersonal skills, strategic decision-making skills, right? So those easily become our assets in the new non-traditional areas as well. So I would say I see actuarial titles becoming more popular beyond insurance companies as a future emerging trend. And actually I want to add a bit is that for us actuaries working in frequent like flyer program, loyalty programs, is actually not something new. So ages ago when this concept exists and the industry realized that it's important to reserve for future redemption cost. And it also gradually developed into a requirement in accounting standard as well. So I know there are actuarial consulting firms that have been experts in this niche area for decades already. And I also know that some of the in-house and consulting actuaries are getting greedier. Like we are proactively working towards some better ways and more robust framework to manage liability to steer our customer lifetime value. So ultimately, it's really being customer-centric to provide a better program for our customers, members, passengers.
Yeah. And I think I like that because I'm one of the members of the Asian Miles. Yeah.
Thank you.
Sorry. Okay, thank you. Justin, so what do you see the trend? Yeah.
Yeah, I'll give two
profession.
trends, one on the career and one on like the overall industry. So the first one is the analyst role that we think of, or the entry-level actuarial role, is going to completely change. Like the day-to-day of like analyzing data and running models. The reality is that with Gen AI, predictive AI, you're going to get 5x, 10x more efficient at it. And I've already seen this in practice where what typically takes a week to look through and sift through data and write up the analysis, Gen AI can do it in 2 hours. So I guess to Anne's point, the focus on more soft skills, getting better at communication, being better at strategy, that's going to be an expectation for actuaries even outside right out of undergrad. And that needs to evolve with the curriculum that we're teaching them, the sort of skill sets that we're teaching them. So that's the first point. I think the second point, and this will take a little bit longer. I mean, we've seen pockets of it here and there, but it's my personal belief is that insurance has always been a claims first industry, right? So you think about there's only really 2 touch points with our customers. There's the point of sale, and then there's the claim. And usually, one, no one wakes up to ever buy insurance. It's not the sexiest product out there. And 2, no, everyone's very stressed out when they're filing for a claim. Because usually it's a lot of money that they're hoping to get back. There's this stigma that, insurance companies are doing everything to not pay your claim, which is not true, but at least that's the customer perception, right? the industry will evolve to becoming a prevention first company in all types of insurance products. Obviously, we've seen it in telematics for motor insurance. At least in the US, usage-based insurance has grown to a certain point now where it's at scale. Still very nascent in Asia, but I think we're going to see more of that for other types of insurance, particularly in health and life. We've seen very early implementations, which are very basic, I think. But in my mind, the future is going to be all about how do insurance companies, potentially partnering with tech companies, figure out how do we prevent risk from happening in the first place so that you're not just selling an insurance policy, you're actually guiding your customers to become less risky so that you don't have to pay the claim in the end.
Thank you. Thank you. Very interesting. Okay, so in view of time, I just ask you the last question is, can you give one most important advice to the students on if they want to prepare for something beyond the traditional actuarial world, what would be one advice to them? So Justin, can you go first?
Yeah, so I think going back to developing your soft skills, right? I think we tend to get very stuck in classes and reading up the textbooks and doing well in exams. The reality is that if you want to build your leadership and your communication skills, which are very critical for any actuary at any level, it's the stuff that you do outside of the classroom, right? So taking leadership positions in extracurricular groups, getting involved with outside organizations and signing up to do things outside of the class are going to be very critical. And especially when we think about communication skills, they become exponentially more critical as you get higher and higher in the ladder. And I don't think we put enough emphasis on that skill set in the earlier stages of entry-level actuaries.
Right. Thank you, Justin. So yeah, I think go outside classroom. I think that's the most important. So Anne, okay, one advice.
I think as actuarial students, one of the top priorities should be to experience more in school. So it can be travel more, it can be read more. And reading is not just, of course, about those like journals, research papers. It's about any topics of art or science that you feel interested in, that you feel passionate about. Because essentially it give you the opportunity to expose to more, and you will become more agile and more resilient. And I think these two features are exactly what's being needed from a good follower and also a good leader in today's business world. And hence, when you become more receptive to new ideas, you will also be more ready to embrace those new and different opportunities and challenges, not just along your actuarial career, but also across the life journey as well.
Yeah, be more open-minded and flexible for new ideas. Yeah, I think that's great. That's great. Go outside the classroom, travel more using Cathay Pacific, maybe. So thank you, Anne and Justin, for your sharing. I think if you have time, I think we will just stop here. And now I will invite Ophelia to give us the closing remarks. So Ophelia, okay, can you just say some words to us? Thank you.
Yeah, thank you, Billy. In fact, a big thank you to all the speakers. It's been a fantastic set of experience like shared by the different speakers, showing us like the very many possibilities of like applying actual skills in different industries. So I personally benefit a lot from today's session, and like through interacting with our different like speakers before today's session, I actually observed that our speakers like have some common traits. So I would just like maybe as closing summarize like the 3 traits that I have gathered like from the different panelists and the speakers. So the first one I would say is curiosity. So I think for actuaries to branch out into the different kind of industries and opportunities, curiosity, like kind of always thinking about like how our skills will make the world a better place. That is like one key thing that I've observed like from all the speakers today. And secondly, the other C is courage. So I think they have all stepped outside of the comfort zone. So I think alluding to what like Anne and Justin just said, like maybe staying inside the classroom or kind of staying with textbook knowledge, that is not going to take us very far. So how do we have the courage to step outside of the comfort zone and explore? I think that would be another key trait, like to actuaries, like realizing the very many possibilities that are available out there. And I think the third one is also C, like the 3 C's, is continuous learning. So like all the speakers mentioned about like studying, like read widely, and then also to interact with different people, and just mentioned that kind of absorbing knowledge from different disciplines. That is like the continuous learning is also key to us kind of realizing the benefits from the different opportunities available out there. So to summarize all these, I will just leave us with like a quote from Mark Zuckerberg. So the biggest risk is not taking any risk. So I think if we as actuaries, we are very familiar with the concept of risk. So how do we kind of like have a more kind of courage in taking risks, and then like applying our skill sets in like different places to kind of improve the world and make an impact. I mean, that would be I think one thing that I think the hopefully the faculty would take away, and then to help us like embed that with the future training of actuaries. Thank you.
Okay, thank you, Ophelia, and I'll thank you everyone for participating in this faculty webcast. So we'll have pleasure with you today, and of course, see you again in the next SOA event. So you may now disconnect. Bye-bye.